Good morning, students. Hope I'm audible. Uh, what we can do is actually one of the important part of your exam. So the discussion of the pre-scene analysis. So this particular presentation I have prepared to cover to analyze the entire pre-scene, right? So I will share with you the presentation after the session, and it will be uploaded in the LMS as well. Right. So, hope you have gone through the pre-scene. So because of that, I'm not going to go through word by word what's there in the pre-scene. Right. So hope you have gone through it several times by now. So because of that, I'll take the important aspect in terms of the accounting standards and the consolidation relating area of SL1. So which actually, if you look at the syllabus weightage of the subject SL1, financial reporting consists of 55% of the syllabus. Right. Moving on. So giving an introduction about the companies before moving into the technical aspects, understanding the case study. This is actually one slide which actually summarize most of the things what is mentioned in the case study, right? So the first company that they talk about is actually Sunshine Construction Private Limited. Initially, it was formed as a private limited family-owned company in 1975, and later on it has become a listed company, right? So where the name was changed to Sunshine Construction PLC, right? So this particular company is mainly to carry out the construction work in relation to building, highways, roads, apartment, and bridges. So the construction services are provided by this particular company. So company was formed by a person called Punchibanda, right? So he actually is the chairman of the company from the inception. And there are four brothers and two sisters that Punchibanda has. And these four brothers were appointed as the directors of the company. So the chairman is Punchibanda. Then four brothers were appointed as the directors, and they have been given shares as well. In addition to that, there are two sisters as well. So two sisters have been given the shares, but not been appointed as the directors, right? Then thereafter, Puchibanda understood that okay, to professionally manage the company, you need to have sound professionals within the board. So that what he has done was he has appointed one of his good friend, right, Kamal Veragaman. He's an executive director. He's actually a practicing CA, right? He was appointed as the finance director to look after the financial related matters. That is Kamal Veragaman. After that, so there's another executive director who was appointed, Gamno De Silva. So he is actually a practicing chartered engineer. So who is actually looking at the operational aspect of the business, right? So this is actually the board structure, right? Board structure initially. Then as I said, this company became a listed company in the Colombo Stock Exchange in 2005. Okay, it has become a listed company. Now it's a listed company. So once this particular company becomes a listed company, what has happened was, okay, before moving there, let me show you the shareholding structure. Look at the focus on this part. What is there on the top left-hand corner? Before it becomes a listed company, Punchibanda held 60% of the ownership of Sunshine Construction Private Limited. Okay, before it has become a listed company, Punchibanda held 60%. Then Kamal and Gamulu, these are the outside executive directors, finance director and the operations director, held 5% each. Then four brothers and two sisters collectively held 30%. You have not been given the individual shareholding. So six people, four brothers and two sisters held 30%, right? This is up until company become listed on the Colombo Stock Exchange in 2005. So it has become a listed company in 2005, right? So with when obtaining this particular stock exchange listing, what you do is you need to have independent directors on the board. So what the company has done was two independent directors were appointed, right? So they are Hemaka Bandara. He is also a chartered engineer. CE means chartered engineer. And Buonaka De Silva, he is having a marketing background. He is a chartered marketing, and also he has some economic background as well, right? So the two independent directors, Hemaka and Buonaka. So the Hemaka is a chartered engineer, Buonaka is a chartered marketer. Then at that time, Kosala, that is, Kosala is actually the son of Punchipanta, chairman's son, was appointed as the managing director of the company. So once it has become a listed company, Kosala was appointed as the managing director. Later, Kosala has become the vice chairman of Sunshine Construction PLC, right? And also, once the company is getting the stock exchange listing, there was a change in the ownership. So which means, so obviously when you become a listed company, you need to issue certain shares to the public, right? So if you look at the shareholding structure after the listing, this is the shareholding structure after the listing. So the public holding is 40%. What has happened was these brothers and sisters, so four brothers and two sisters, agreed to sell their stake to Punchibanda's son Kosala, right? At the time of getting the stock exchange listing, this 30% holding held by the family members, four brothers and two sisters of Punchibanda, was transferred or sold at market value to Kosala. Kosala means son of Punchibanda. So that is this. So the percentages are not exactly tallied because why? With the stock exchange listing, there's a issue to the public. So the number of shares are going up. Then Punchibanda has its holding of 40%. After the listing, Punchibanda's holding is diluted to 40%. Kosala is holding 16%. If you look at father and son are collectively holding how much? 56%, 40% and 16%. That means it's a, even though it's a listed company controlled by this family, Punchibanda's family. Then the two executive directors, that is outside two directors, Kamal's and Gamunu's holding was also diluted to 2% and 2% each. Earlier they had 5% each. Now it has been diluted to 2%. And the public holding is how much? 40%. Right? So this is actually the brief introduction about the first company that is mentioned in the case study, or the main company, I would say, Sunshine Construction Private Limited initially, that was formed in 1975. And later on, it has become a listed company in 2005 with the name change of Sunshine Construction PLC. Right? Then we are moving to the second company, what is given in the scenario. Sunshine Manufacturing Private Limited, SML. This was formed in 2003. So the main idea is actually to produce materials to support the construction work of Sunshine Construction, right? So you have a construction company. Why don't you have the backward integration where, so the Sunshine Manufacturing Private Limited, they are expecting to manufacture the construction related material. Okay, might be selling to the outsiders as well, right? So it's a related business. So this is actually, this particular company was formed with a outside investor, reliable investor called Somapala, right? So Somapala was given actually 20% shares of this company, Sunshine Manufacturing, SML. So the remaining 80% is held by the parent company, that is the first company that we discussed, Sunshine Construction Private Limited. So only two shareholders there. So their main business is actually the production of autoclaved aerated concrete blocks. These are big concrete blocks that is used for the construction activities. So the production plant is in Utlam, and they do the manufacturing make to stock and make to order. Make to stock means here inventory is getting accumulated. Now this is an important information because why? So in the case study, when you are going through, you'd have highlighted that, you would have looked at. So the projects that have been, like started is kept on hold, right? So might have been even the inventory what you have manufactured might be lying there on the warehouses. So you might have a, situation where inventory, you have to check that whether the cost you need to compare and see that with the cost and the NRV, whether the NRV is less than the cost. In that case, there will be a inventory write-off, right? So make to stock and make to order means once you receive an order only, you do the manufacturing. So the Sunshine Manufacturing carries out manufacturing make to stock as well as make to order. So in this company also, Punchi Banda is the chairman and MD. So the Somapala, the other investor who holds 20%, was appointed as the managing director of the company. Somapala is also a chartered engineer, right? A lot of people in this case study are having engineering background, right? So at the time of forming the company, Kosala, that is Punchi Banda's son, was appointed as an executive director of this particular company. So the Kosala was a executive director at the time of forming the company, at the time of forming the SML in 2003, right? Then the third company, what is there in the case study? Sunshine Real Estate and Residency Private Limited, right? SRERL, okay? SRERL, okay? That was formed in 2005. That was formed in 2005. Actually, this was formed with Sunshine Construction is getting the stock exchange listing. Actually, to form the funds or to incorporate this company, Sunshine Real Estate and Residency, funding was gathered by Sunshine Construction is doing an IPO. Okay, so in 2005 over here it's mentioned Sunshine Construction obtained the stock exchange listing in 2005. So they have done an IPO, collected money, invested in this new company, Sunshine Real Estate and Residency Private Limited. Okay, so that's a real estate company like commercial land, residential property development activities, construct apartments and the housing scheme. Again, they are, diversifying into the related industries, right? So funds were raised from an IPO, as I mentioned, done by Sunshine Construction PLC. Okay. Then, so if you look at the shareholding, actually Sunshine Construction Limited and thereafter Sunshine Construction PLC holds 100% shares of this real estate company. Okay, Real Estate and Residency Private Limited is 100% owned by the parent company, that is SCL, that is Sunshine Construction. Thereafter, as I mentioned earlier, Punchibanda's brothers and sisters sold their shares to Kosala. So, which means now over there, so over there, 4 brothers and 2 sisters held 30% holding, right? So once SCL become a listed company, what they have done was their shares were sold to whom? Kosala, Punchibanda's son. Okay, even basically these two information, even though I have put under the SRERL, I would say SRERL, this particular company. So those are relevant with the what? First company, that is with the parent company. Parent company has done an IPO. And at the time of doing the IPO, there were there was a public issue. And the shares held by the family members, brothers and sisters, 30% was transferred to Kosala at market price. Then talking about this real estate company, they have a condominium with 225 luxury units in Kolpiti. Then there's a land in Kotte. So this is actually a property held by this real estate company. In addition to that, there's a land in Kotte to build and sell individual units to suit the specific customer requirements. So it seems that they have two main projects. One is condominium. The other one is there's a land. So why this land is kept is to construct or to build and sell what we call individual units, individual housing units based on the specific customer requirements. Okay, so the design is specific. This is very important information when it comes to accounting, right? Design is specific. You are adhering to the customer's specific requirement, and where you build and sell individual units for each person. Then hope you have noticed that if you look at, because after the under the financial information, after giving the P&L and balance sheet, or somewhere they have given actually the segmental information about these three business units, actually these three businesses. They have given the segmental information. If you carefully look at the segmental information, this particular company, due to the current situation of the economy, are facing challenges. Not only this, but also the other two companies as well. But this company might have been facing, a lot of challenges because real estate sector, because with the economic downturn, people are not investing in real estate, right? A lot of companies have been closed down as well. So this particular company has a situation of a negative net asset. Okay, so then what would it be meant? So you might have a situation of material uncertainty about the going concern. So we look at that later, right? Okay. So these are the information what is available in the case study. In addition to that, highlighting some other specific or other important matters, I would say, group revenue dropped by 13% in the current year. If you look at group in the sense, these three companies. Now, Sunshine Construction is the holding company, parent company, and Sunshine Manufacturing and Real Estate are the subsidiaries, right? So if you look at the entire group, 13% drop in revenue. If you look at the parent company's revenue, that is SCP, Sunshine Construction PLC's revenue dropped by 24%, 13%, sorry, 24%. Then margins have been eroded drastically. Group gross profit has been reduced from 22% to 14%, significant decline. Okay. Then the parent company's GP has come down from 19 to 17, comparatively less, but it has come down. So that means you have the financial pressure. So you have the margin pressure. Okay, so the lecturer who is doing this governance, risk and ethics, so these are kind of so he definitely would have highlighted, or he will highlight that. So the margin pressure, revenue pressure is a kind of a, indication where management can do the, fraudulent activities to increase the revenue, increase the profit. That would lead to a material misstatement. Okay, so then we need to look at that, okay, whether the accounting standards have been properly followed. Now, when you have a pressure, so where to make a material misstatement, you need to clearly look at whether the relevant accounting standards are properly followed. So throughout this session, what we are going to do is actually to look at the case study from the angle of the accounting standards and see that what accounting standards are applicable and how the accounting standards are to be correctly followed. Okay, if there are any mistakes, deviations that you can then identify. Right. Then thereafter, further information was given about this manufacturing company, Sunshine Manufacturing Private Limited. So during the current year, that is 22-23 year, Sunshine Manufacturing made a loss of 38 million. And the demand for the products dropped by 60% compared with financial year 18-19. Why 18-19? Because last couple of years or 3 years was not a good conducive business environment for a lot of businesses, especially who are in this industry, construction industry. So we have this economic turmoil, and then before that we had COVID, right? Number of issues, import restrictions, dollar shortages, terrible time. So comparing with before the pandemic situation, before the COVID situation, even that is when comparing with 1819, as of today, the demand for the construction material has declined by how much? 60%. This is a real situation in the country, right? This is a real situation of the country. Then, in addition to that, people now, let's say your demand, there's a demand drop, your sales are less. Not only that, even for the items that you sold, it's difficult for you to collect money. For example, your receivable has increased from the government as well as corporate sector. Government doesn't have money to pay. Lot of people who supply the goods to the government, not only the construction industry, but even the other industries, like, power generation, power plants. So they supply the electricity to government. Government has not paid, right? Then pharmaceutical. So the companies who are in the pharmaceutical industry, they sold, these pharmaceutical items to the government. Government has not paid. So similarly, so this company has done a lot of projects for the government and the government has not paid. And not only that, companies are also struggling, right? People don't have the purchasing power. So because of the inflation, there's a decline in the demand for their products. So they don't have money to pay. Now the projects what you started, right? You would have, so the projects what you have started, you would have sold these materials, but still you didn't collect money. So the receivable has gone up by 50% compared with the financial year 18 and 19. So definitely now you have certain matters in relation to the accounting standards like impairment of receivable, right? Impairment of receivable that has to be looked at. Then overall, you need to look at the revenue recognition, because in the construction industry, how do you recognize the revenue? In terms of the real estate, how do you recognize the revenue? Okay, so what's the relevant standard? We'll be looking at that in a little while, right? Okay, moving on. What else? So I'm summarizing the entire case study in one slide. That's why I'm taking a bit of a time rather than going through the, PDF one by one, word by word. So this is much useful. So you can remember the things. Easily. Then large pending projects were counted under inventories, and last year's progress of these projects was poor. Now tell me, what do you mean by pending projects accounted under inventories? What does that mean? Let's say you undertake a project, right? You undertake a project. That particular project is not yet completed. Okay, let's say you want to construct a house for someone, right? So that house intention is to construct, build, and sell. But now what has happened was suddenly there are many issues, import restrictions, so that you can't import the relevant material that you need. On the other hand, the person who is supposed to buy doesn't have income to buy the property. So because of these various reasons, and there were lockdowns and you can't carry out the construction activities sometimes. So because of that, so these projects are not completed. They are, classified under inventory because those projects are for the purpose of, to sell. So now the progress of these projects were poor. So which means we need to apply the inventory valuation, LKS 2, and see that whether now you might have accounted these inventories at cost, whether the NRV is less than the cost. If the NRV is less than the cost, there will be an inventory write-off. So you need to look at these aspects. Then this one I have already explained, trade receivable of the group. That means all three companies as well as parent company SCP have gone beyond the group credit policy of maximum 45 days. So it seems that group policy is to have credit period of 45 days. But most of the cases, it seems that customers are not making the payment. It has gone more than 45 days, which means impairment allowances for receivable to be looked at. Then very expensive modern plant and machinery were not utilized at full capacity due to low demand and the tight financial position. So what has happened? Low demand. So there's no demand for the product. There's nothing to manufacture. So that the plant and machinery are idle. It's not utilized in the full capacity. And also company can't make the further investments because might have been, so this plant and machinery was brought in and there are some other equipment that you need to use these plant and machineries. As the tight financial situation, company can't invest on these equipments to use the machinery already brought in, right? So what the standard that comes into your mind here? Obviously, LKS 36 impairment of assets, right? This PP&E item would have been impaired, impairment indicator. You have to do the impairment testing. Then bank is putting pressure due to outstanding overdraft facility, urging the debt of the group need to be restructured. So like the country, at the moment, there's a debt restructuring going in our country. So similarly, now the three companies in the group is finding difficult to make the payments on time because they have a tight financial situation. So they are in an industry which is heavily affected because of this economic downturn, right? So now what bank is saying is restructure your debt. So which means restructuring means what? Either you need to extend the tenor. Okay, so they extend the tenor. Or maybe to, renegotiate the interest rates. Okay, so but bank is now putting pressure here. If you don't pay, at least restructure. So now what would it comes to your mind here? You have financial liability on your balance sheet where you are finding it difficult to settle that financial liability. So you have a material uncertainty about the going concern assumption, right? Because if you don't do it, if these, properties are secured against these bank facilities, it was not mentioned in the question. So the bank might acquire these, production plants and what are the properties that the company is holding. So if you can't pay, if you don't do the restructure, right? So there's a material uncertainty about the going concern assumption, right? So these are the main aspects that we need to know in terms of this case study. Now, what I would do is our analysis is based on two things. One is, first of all, I would look at the uh, accounting standards, what is relevant for this particular case study, and thereafter consolidation. Because if you look at the last few papers, always in the unseen scenario, that is the third question of the paper, in addition to the consolidation question, always there were questions from the accounting standards. Now, recently, last time, there were questions from LKS 41 and SLFRS 16, right? Agriculture and the leases. Similarly, in each and every, paper, right? In your unseen scenario, yes, there's a consolidation. In addition to that, accounting standards are also tested. So because of that, we need to understand what are the accounting standards which are important for this case study, right? Out of that, I would say that the most important accounting standard for this particular matter, based on the industry that we are in, is actually SLFRS 15 revenue recognition, revenue from contracts with customers, right? So you should know in and out of SLFRS 15. I will highlight the important aspects. I might not have time to go through the entire standard because it's a very lengthy standard, right? Hope you have watched the videos related to that. And if not, ensure that you watch them again, right? That's very important. So what I would do is, so anyway, people who are there in the theory course are having the access to the videos, right? So even if you are in the revision course only, what I would do is I will tell the admin team to upload the videos, all the videos relevant to SLFRS 15 into the revision course as well, right? They are, if you have not watched the video, then what you can do is I'll tell you the specific areas that you need to focus when watching the videos, so you can watch and update your knowledge in terms of the areas what I'm going to discuss now. Okay, right. Hope it. So hope you understood up to now. Any questions up to now? If not, we can move on and discuss about the application of the accounting standards. Right. So let's start the accounting standards. First of all, accounting standards applications for the things what I have discussed. So in this particular slide, right? There are other areas as well, but let's apply the accounting standards to things that we have already discussed first, right? Okay, so the first standard, as I mentioned, SLFRS 15, revenue from contracts with customers. I'll highlight the important areas. Again, I'm not going to go through all these things. So all of you know, there are 5 steps of recognizing the revenue, right? So identifying the contract and identifying the performance obligations within the contract. Performance obligation would be, to construct a property, right? So construct a property, then determining the transaction price, how much of consideration that you're going to collect from the customer for the construction of property. Then allocate the transaction price to each performance obligations. If you have more than one performance obligation, you need to allocate the transaction price to each performance obligation. If you just have only one performance obligation, so the entire transaction price is related to that particular performance obligation. So what is important in this case study is actually the step number 5, recognizing the revenue when each of the performance obligation is satisfied. So you have to know that what is the time at which I should recognize the revenue. What is the time at which the performance obligations are satisfied. Now, you know that when it comes to standard, there are 2 approaches that it discusses in terms of the revenue recognition, right? So what these 2 approaches are is overtime approach, that is performance obligations are satisfied over the period of time, as well as satisfaction of a particular performance obligation at a particular point in time, over time and point in time. So at the inception of each and every contract, what you need to do is you need to decide how am I going to recognize the revenue? What is the pattern of satisfying the performance obligation, whether it is over time or point in time. Now construction projects means what? It takes period of time to do the construction, right? It's not like, manufacturing of let's say manufacturing of a toy, right? It would relatively do within a short period of time. It's not like performing a service, like maybe a cleaning service. Construction would take certain period of time. So certain construction projects would drag up for years. Now, under the current conditions, it was mentioned that projects were delayed. Okay, because the situation of the country was not that good. So because of that, at the inception of each and every contract, I have to decide how I'm going to recognize the revenue, whether it is point in time or over time. The guidance given in the standard is very important for this matter, right? That is what the standard says is when you have a performance obligation, first of all, look at whether the performance obligation is satisfied over time. For you to say that it is satisfied over time, one of the following criteria are to be met, not all 3. If one of the 3 conditions are satisfied, you say that it is satisfied over the period of time. You recognize the revenue over the period of time. I'll, like give the examples within this case study once I go through these 3 bullet points. First one is customer is receiving and consuming the benefit of the seller's performance simultaneously as the seller performs, which means seller performs and customer benefits simultaneously. So this particular one is mainly applicable for the services, right? So most of the services are coming under that. Now let's say lecturing is a service. I'm performing the service, you are obtaining the benefit simultaneously, right? So because of that, the first one is not that applicable into this particular scenario. Look at the second one. Second one is important. Seller create or enhances an asset. Create or enhances an asset that customer control as it is created or enhanced. Now let's assume a scenario. You go and do something on a land belong to a particular customer. you carry out the construction activity. So there are a lot of construction projects over here. No? Now, once you are doing the construction activity, right, who has the control over this asset, what you are constructing? Customer. Because whatever the, now let's say if some disputes or something occurs in future, and if the work stop, whatever the construction activities that you have carried out is belongs to whom? It belongs to the customer. What you can do is, if you have certain materials, you can bring them back. That's fine. But whatever it was constructed is controlled by the customer. So normally, as per the agreement, if the land belongs to him, so the work it has been done is with customer's control. So if that is the scenario, what it says in the standard is recognize the revenue over the period of time. So you know the total consideration, total transaction price. If 40% of the work is completed, whereby creating or enhancing an asset while the construction customer controls, you recognize 40% of the revenue, because revenue to be recognized over the period of time. That is the second one. Then the third one is very critical, right? In third criteria, actually, there are two things to be satisfied to recognize the revenue over time. What is that? Seller's performance doesn't create an asset with alternative use, which means the asset that seller create is a specific asset, right? Customized asset. Now, seller performing his part and creating an asset which doesn't have any alternative use to the seller. Seller has to sell that to the particular customer, not to anyone else. If seller wants to sell that to anyone else, seller has to incur huge cost, huge economic loss. Right? So because of that, we say that these assets are customized, specific assets, no alternative use to the seller. And not only that, and that's why I said that two conditions are to be met. Seller has an enforceable right to payment for the performance completed today. This is also very important. Enforceable right to the payment for the performance completed today. That means if 40% of the work is completed by now, seller should have a right to collect 40% of consideration. Right? So now in the third scenario, let's assume now in this case study, it was mentioned that, so the best example what I can take is there's a land. In that particular land, company wants to build and sell individual units with specific customer requirements. Right? So what you do is, so the land belongs to company, that is Sunshine Real Estate Residency. So during the construction, asset is controlled by the company, not by the customer. So earlier, in the second scenario, during the enhancement, during the construction, asset is controlled by the customer. But here it's not like that. It's land belongs to the company. But on that land, company construct properties or individual units which are specific to customer requirements. So if that particular customer doesn't buy that, company doesn't have any alternative use, because these are his requirements, right? Not only that, okay, now you understood about that. What does that mean by seller's performance doesn't create an asset with alternative use to the seller? And not only that, contractual terms should provide the right to the seller. Seller should be protected. Now, if something goes wrong and project is stopped, right? Let's say 40% is completed, something went wrong, project is stopped. Seller should have the enforceable right. That means contractor should have the enforceable right to collect the payment for the work that he has done. Okay, if he doesn't have an enforceable right to collect the payment for the work he has done, can we recognize the revenue over time? No. Asset is a specific asset, specialized asset, and also seller must have an enforceable right to collect the payment for the work he has done. So In that case, again, if this and this both satisfied, means you recognize the revenue over the period of time. I hope it is clear for you what are the three situations where the revenue is recognized over the period of time. Then if now what you look at is at the inception of the contract, you need to look at this evaluation, whether the performance obligation is satisfied over time or point in time. If the particular performance obligation that you are looking at is coming under one of these three, again, one of these three, you recognize the revenue over the period of time. If it is not coming under any of these three, which means that what automatically the revenue has to be recognized at particular point in time. If not coming under any of these three, it has to be point in time. Right? So simple example, let's say sale of goods. I manufacture, let's say concrete blocks. I manufacture and sell. Right? That is sale of, normally sale of goods are recognized, the particular performance obligation is satisfied at a particular point in time. So where the control is passed, not coming under any of these three. So then it is point in time. Hope you understood, right? Right. Then once you decide, now why it is important so much in this case study, because you are into construction. In the case of the construction, you now need to look at the contract and evaluate and see that whether the second condition or whether the third condition is satisfied. If second or third condition, because the first one is not applicable that much in the construction industry, right? Second and the third one are the critical ones. If these are there in the nature of the contract, apartment sale, housing complexes, right? So then they have condominium. So all these to be evaluated based on this. Now let's say if you decide, yes, performance obligation is going to be satisfied over the period of time, then what will happen is you need to decide how am I going to recognize over the period of time. Now the construction activity might go for 3 years. So during these 3 years, how do I recognize? How much in the first year? How much in the second year? How much in the third year? I have to decide. So for that purpose, what you need to do is you have to measure the progress towards the completion. Right? So you have to measure the progress towards the completion. Progress towards the completion can be measured by using different methods. I'm not going to go through each and every slide because, as I mentioned, we have gone through this. You should have watched these videos. As mentioned, if you have not watched the videos, doesn't matter. I will ask admin team to upload that into the revision course as well. Those who are there in theory course anyway, you have the access, but for the others even, I will ask them to upload the videos into the revision course where you can go through these things in detail if you don't understand, or if you need to, go into deep into details and understand. Right, so we are discussing about how to measure the progress towards the completion. Because if you look at this industry, actually I have done my own research before doing this session by going through the annual reports of several companies in this industry like Access Engineering. In a little while, I will share these things with you, annual report, important aspects, the important pages that you need to look at. So in this industry, there are different methods people use to measure the progress towards the completion. Right? Why? The standard allows that. Standard allows each company to select their method of measuring the progress towards the completion. Once you select that, apply that in, similar performance obligations and the similar circumstances. So these methods that you use to measure the progress towards the completion are mainly two types: input methods and the output methods. Input method means actually you measure the progress by looking at the seller's effort, how much of effort that the seller is making. So the seller's effort, or the main input method that we have in practice, is actually the cost basis. What do you mean by cost basis? You know how much of cost that you have incurred as of date. Then, you can estimate how much cost that I need to incur in future to complete this project. So in the cost method, what you do is you take cost incurred as a proportion of total expected cost. Out of the total expected cost, how much I have incurred up to date. Based on that, calculate the progress towards the completion and say that this is the percentage. Let's say if it is 40%, you recognize 40% of the revenue. Are we clear? The other method is output method. Output method, you look at the value of these goods and services to the customer. What is the value of the goods and the services that you are going to transfer to the customer? There are two main output methods. One is survey of performance, which means there's an outside independent party carry out a survey and say that out of the total contract, let's say 35% is completed by now. This is the amount of the, this is the value of the work done up to date out of the total contract. That is the survey of performance. Or else time elapse. Time elapse mean what? Let's say you have 3 years, there's a particular contract, 3 years. So in the 3 years time, you recognize the revenue on how much of time it has passes. With regard to construction projects, normally you don't use the time elapsed basis, right? If it's a service contract, I told you now the first scenario is mainly relevant with the what? Services. Okay. So with regard to the services, service contracts, to measure the progress towards the completion, you can use the what? Time elapsed. So if it's a 3-year service contract, out of that, if 1 year has completed, you recognize 1/3 of the revenue. Right. Okay, what we discussed, all these things, what I would do is, I will discuss the theory, then I will go and show you the real details in real world annual reports, right? So having this knowledge is good before we go to the annual report, then I can quickly explain to you and go into the detailed discussion when I'm looking at the annual reports, right? Okay, so what we discussed, there are two methods, input methods and the output methods, to measure the progress towards the completion when the performance obligation is satisfied over the period of time. Right. Next thing is, now let's say in the exam, if examiner wants to test the numbers with regard to, especially with regard to a construction contract, where the performance obligation is satisfied over the period of time, how to do that? You should be aware, right? So there are one of the fundamental things that you need to look at is, when revenue is recognized over the period of time, what would be the expected outcome? What do you mean by expected outcome? What would be the overall result of this contract? So how to get the overall result of the contract? You know the price what you have agreed with the customer. You know the contract price. Then you know how much of cost that you have incurred up to date. That you know, no. Then you can estimate how much of cost that I am going to incur in the future. Then you can see that overall, am I going to make a profit or loss? Normally it's a profit, right? So if your expected outcome, overall, if you are going to make a profit, the way that things are recognized in the financial statement is different to the situation where you are going to recognize the things in case if you are going to make a loss overall. Now, if your expected outcome is a profit, very simple, what you do is both revenue and the cost relating to the construction activity recognize based on the progress of the contract. Earlier, we measured what? Progress towards the completion. Let's assume progress towards the completion is 40%. You measured that earlier. Then you recognize 40% of the revenue, 40% of the cost. Simple. But your expected outcome is a loss. What is the word that you can remember here? Student who study hard So remember, if you know that you are going to make a loss out of a contract, what contract is that? Who can remember? You know for sure you are going to make a loss. Your overall outcome would be a loss, but still you have to continue with the contract. You can't just cancel the contract. Onerous contract. We learned that under LKS 37, provisions, contingent liabilities, and contingent assets. So if your expected outcome is a profit, you recognize percentage of revenue, percentage of cost. That means you recognize percentage of profit, not the entire profit, right? Okay. If your progress is 40%, 40% of revenue, 40% of cost, which means automatically 40% of profit. But if your expected outcome is a loss, what you do is you can't recognize a percentage of loss. You have recognized the entire loss. Whole loss should be recognized immediately by recording a provision as an onerous contract. It's an onerous contract. You have to make a provision to recognize the entire expected loss immediately, right? How to do that? I'm not going to explain that here. That's why I mentioned that. So I have done that in the theory video sessions, the questions relating to all these things. You can watch the videos if you can't remember the numbers, but this is the idea because we don't have time to discuss everything. I just need to remind you these are the important areas that can be tested in the examination. Right. Then in the case study, it was mentioned that there are certain contracts where you don't know the outcome because let's say at the early stages of a contract, you might not be aware about exactly about the expected outcome. If the expected outcome is unknown, it's in the early stages. I can't say that it's an overall profit or overall loss because I can't estimate the future expected cost. You can't estimate the future expected cost. It's uncertain. So when you have that kind of a situation, what are you going to do? Let's say it's a construction contract. You can't reliably estimate the overall outcome, but still you incur certain costs, right? Because you are carrying out the construction activity means you incur certain costs. Those costs are there in my P&L. Then what you do is you recognize the revenue only to the extent of recoverable cost. You know the cost, no? You know the cost value. What amount of the cost, let's say charge the P&L is 50 million. You charge the P&L. Then you recognize the revenue equal to the amount of the cost that can be recovered. So let's say if the entire cost can be recovered, normally entire cost can be recovered, you recognize the revenue also amounted to 50 million. Then cost is 50 million, revenue is 50 million, no profit, no loss, right? So in this case, revenue should be recognized to the level of recoverable cost. Are we clear? I hope you understood about it. Okay, so, right. That is how you apply the step number 5. Now, during this 1 hour, what we discussed was, analyzed about the, we first of all discussed about the information about the 3 companies and the other important information relevant to the case study at the first, half an hour. Thereafter, we spent on recognizing the revenue. What are the main areas of the revenue recognition standard SLFRS 15 that you need to be aware by giving specific reference to the case study. Then you should also know this particular point, right? How to ultimately, let's say if the examiner is asking you to present the figures in the financial statement, presentation of these, recognizing the revenue, cost, profit in the financial statement, you should know how to present it. There, I told you now in P&L, statement of P&L relating to a construction contract, what you have is the revenue and cost. That's simple. With regard to revenue, I told you how to take the revenue. How to take the revenue? You know the total contract price. You know the total contract price. That into the progress towards the completion. Let's say the total contract price is 10 million, right? Let's assume 10 million. Let's assume you have completed 40%. So how much? You take 4 million here. This is very important. All of we know that P&L is prepared for 1 year, right? So this is 4 million. I'll put it here. Then all of us know that we prepare the P&L for the particular year. Then if you have already recognized any revenue in the previous year relating to this contract, that has to be deducted. Okay, let's say this is the second year of this contract. So it was started in the last year. So in the last year, you recognized 1 million revenue, already recognized 1 million revenue. Then during the current year, how much you to recognize? 3 million. Okay, you take the total price. This is what I wanted to mention you. You take the total price, multiply it by the progress towards the completion as at the reporting date. You get the figure. Out of that, deduct whatever the revenue that you have recognized in the previous years. In the previous years, let's say you recognized 1 million, then current year you should recognize only 3 million. Similarly, when you take the when you take the cost of sales, you take the total cost, which is cost incurred to date plus expected cost to be incurred in the future. Take the total cost, multiplied by the progress towards the completion. Let's assume total expected cost incurred plus to be incurred 8 million. Progress towards the completion, earlier we calculated, let's assume 40%. How much is that? 3.2 million. Out of that, if you have recognized any cost in the previous years, right? Let's say you recognize 0.8 million in the last year. You deduct that. Then how much do we recognize over here? 2.4 million. Right? So because P&L is for a year, but if you have recognized something related to this contract in the previous year in the cost of sales, that has to be deducted. So 3 minus 2.4 during the current year, you recognize how much? 0.6 million profit. This is how you do. This is how you present the things in the P&L. Are we clear? Are we okay with it? Then statement of financial position, we know that is not a particular period, right? The basic accounting I'm teaching you, but still important when it comes to the exam, if examiner tests the numbers with regard to a construction contract. Because I can remember so the examiner has tested a question July 2021 paper. So what you can do is actually, now I'm telling you what to do, right? Because you have enough time to get it prepared well into the examination. So if you can't remember the areas what I discussed in terms of the SLFRS 15, you need to go back and watch the videos, revise your knowledge. And also, so in the revision course as well as theory course, the past paper question, July 2021, first question number 1, part A. Yes, question number 1, part A. So there's a construction contract question. Look at that question. So there you have this, you have this scenario what I'm explaining to you, part of the scenario. So you can practice and, get it prepared. Right. So, so the point what I want to mention is, with regard to the statement of financial position that is prepared for a particular date, that should have the cumulative amounts, not for a particular period. So because of that, what you should show in the statement of financial position with regard to this contract. 1 second. Right, what you need to show in the statement of financial position. So, so this standard SLFRS 15 introduces this terminology, contract asset, contract liability. You have to show the contract asset or contract liability with regard to this construction work. How do you do that? How do you do that? So you just put the numbers, you get the answer. So this is the format that you need to follow. First of all, take the cost to date. That is actual cost, not the cost of sales, right? A lot of people are taking how much of cost of sales that I have recognized. No, how much actual cost you incurred up to date, total cost, actual cost, what you incurred, cost to date. Then if it's a profit, if you have recognized profits, because earlier I calculated the profit in the current year, even in the previous year, you would have recognized a profit. So if the profit what you have recognized in total relating to this contract, you add. If it's a loss, the total loss up to date related to this contract, deduct. Cost to date plus profit to date. If it's a loss, minus loss to date. From that figure, deduct amount what you bill to the customer. Because if the construction is a long-term project, you are billing to your customer over the period of time. So you put bills, maybe, like you have put 3 bills to the customer up to date for him to make the payment. So amount what you have billed to date, total amount, cumulative amount, you deduct. Then you get a plus figure or a minus figure. If it is a plus figure, that is a contract asset. If it's a minus figure, it's a contract liability. So very simple. In the balance sheet, you have to show that. Okay? In the balance sheet, you have to show that. So what does that mean? Now, this is technical aspect. No? Now, logically think, you get a positive figure. Contract asset, what it is actually. So that is the real learning. Not to be parrots, understand the logic as well. What is it? That is the amount of the work you have done, you have not yet billed to the customer. You haven't billed it to the customer. In future, I can bill. That's why it's asset. You have done the work, but you have not billed it to the customer. If you get a minus figure, a liability, contract liability, what is the meaning? Customer has paid you more. You collected advances from the customer. That's why it is negative. Right? Okay. That is the contract asset or the liability. Then you might also have, you might have or you might not have, depending on the situation in the question, you might also have a situation of a receivable or a payable balance in the balance sheet. Because we are talking about the presentation in the statement of financial position. So how much you have in the statement of financial position as the receivable or the payable, how do you get that figure? Amount billed to date. Here you have the number, that particular figure, what you have put here, you take into here. How much you have billed to the customer. And out of the amount what you have billed, let's say you bill up to date, example, let's say up to date you have billed 35 million. Okay, so the 35 million, what you deducted over there is taken over here, 35 million. Out of that, customer has only paid 32 million. Payment to date. So which means what? 3 million receivable. So what does that mean? I have billed it to the customer. I put a bill, I put an invoice, he has not paid. Trade receivable, very simple. Similarly, if you get a negative figure, let's say you bill 35, customer has paid 37. That means negative. If it's a negative 2, that means that it's a payable. Customer has overpaid. Clear? Understood? So remember, always in the balance sheet, figures are not for a year, cumulative figures. But in the P&L, yearly figures, relevant to the period. That's why whatever the revenue, whatever the cost of sales recognized in the previous years, you deduct. Okay, I spent a lot of time to explain you. Hope you got it. Right? So is that understood? You are okay with that? So we'll look at what you call annual reports to understand this in detail a little bit, right? Right. So then this one I have already explained. You have number of scenarios where the inventories are created. Now, let's say when it comes to this, look at this construction industry. When you have, or when you are constructing properties, depending on the scenario, it can be classified under different accounting standards, right? If you have the contractor-contractee relationship, right? You are constructing something for a specific requirement of a customer. Then you have the contractee-contractor relationship. So for that, what is the accounting standard applicable? We just discussed? What is the accounting standard applicable? So this is how you account. This is your profit and loss statement. This is your statement of financial position. You have to apply SLFRS 50. SLFRS 50. right? Because earlier you have a separate standard for the construction contract. Now it's no more there. It's now covered under SLFRS 15. This is what you have to do. Then you might have completed. Now your intention is construct and sell. I'm taking a different example, right? Construct and sell. Then you have completed units. There are certain apartments already completed. There are certain housing complexes already completed. Then I'm keeping that up until I find a buyer. What is the applicable accounting standard? Inventory. Because this particular property would become an inventory. Then a company like Prime Lands. So they have lands, different areas in the country. What is their intention of acquiring these lands? To sell. They would do certain, developments and sell. So they have to classify these lands in their books as what? Inventory. If your intention is to sell, inventory. So the completed units of apartments, lands that you have is inventory. Not only that, there are other inventories in this scenario because there's a company to manufacture construction material, right? If you manufacture, make to stock, you have inventory. That is also inventory. So a lot of information have been given where these inventories are lying over many number of years, so that always need to check that whether the valuation is correct, because in the financial statements, those are recorded at cost mostly, but you need to compare and see that whether the NRV, because inventory measurement is cost to NRV, whichever is lower. If the NRV is less, you have to write off certain amount of inventory, right? So before moving to the, okay, before, second, yeah, before moving to the financial assets, next one, let's look at the annual reports of few companies. Okay, this is the practical learning, right? So one of the company I would take is actually access engineering, similar type of scenario. But I know that now don't try to read all 288 pages in this annual report and waste time, right? So that's why I'm helping you. I know that you all are really busy these days, so I have done the research by myself and I will show you what are the important areas, right? Just focus on those. Don't waste time on reading all these things. Huh? Uh, so here also a lot of things are there, but what is important for you is, these are I said that the business that this company is undertaking is relevant to the case study, right? So they have the construction arm, constructing roads. What I have highlighted is the businesses that it is mentioned in the case study. So constructing roads, highways, building, then bridges, flyovers under the construction division. Then you have construction related materials, same thing here. Autoclaved, aerated, concrete blocks production. So they have a section or a sector to construct or to produce construction related materials. So they produce the same material what is there in this case study. And also they have a property development property development sector, which means apartments, commercial buildings, real estate services. Yet again, this is actually similar to the third company. So the engineering projects are relevant to the first company, parent company. Construction of material are relevant to the manufacturing company, second company, what is given in our case study. And this is similar to the third company, what is mentioned in the case study. Okay. And also, if I go further down, now this particular page is page number 45, right? Page number 45. If I go down, I can show you another important aspect about the segmental reporting. So even in the case study, you would have gone through, you have been given the details about the segments, or basically the three business sectors. So three business sectors are coincide with the three companies that the case study talks about. So that segmental information presentation or the classification that is used in our case study is, I would say, identical to the classification used in this particular annual report. Okay, so so here it's mentioned that group's primary format for the segmental reporting is based on the business segments. These business segments are determined based on the group's management and internal reporting structure. So they have identified the sectors or the segments based on the business that these companies are carrying out. So you can actually, if you have time, you can read this particular section. But what is most important is what I have highlighted over here. Then these are the segments that they have identified. Construction segment, that is to construct building and the other infrastructure. Then the construction related material. So these concrete blocks production and all. Then the property development, commercial and the residential property development and providing necessary services. In addition to that, in the real scenario, access engineering, they have another segment which is not there in our case study, automobile. So that is not relevant to this particular case study that we have. But the first three are, I would say, identical to the case study that we have in hand. Okay. Then if I go down and see the revenue, right? This is one of the most important accounting policy. They are even, I'm not going to go through the entire thing. I will highlight the aspects that we discussed. With regard to the revenue, they mentioned the accounting policy. So what we already discussed, over time, point in time, all these things are explained. And with regard to the construction contract, this is what is mentioned in the accounting policy. If I read the highlighted areas, again to save time, what it says is at contract inception, group determines whether it satisfies the performance obligation over time or at a particular point in time. At the inception, you need to make that call. The revenue recognition occurs at a point in time when the control of the asset is transferred to the customer. If the revenue is recognized by using the point in time approach, you need to recognize the revenue once the control is passed to the customer. Now, good example would be, let's say I have a completed housing unit, right? Now, I have completed a particular housing unit. Then I keep that in inventory. Then there's a customer, buyer. I sold that housing unit to him. So in that case, performance is satisfied particular point in time. Once the control is passed, normally at the time of passing the legal title of the property, I can recognize the revenue point in time. Then for each performance obligation satisfied over time, group recognize the revenue over time by measuring the progress towards the completion. When it says for each performance obligation satisfied over time, the group recognizes the revenue over time by measuring the progress towards the completion, satisfaction of the particular performance obligation. You need to measure the progress towards the completion. That we know, if it is over time, you need to measure the progress towards the completion. Then what it says, this is the point what I wanted to mention. The progress is assessed based on the what? Survey of work performed. So this particular company, Access Engineering PLC, to measure the progress towards the completion, what they have done is they have selected an output method. What is the output method? Survey of work performed. That is the method that they have selected. Are we clear? It's different from compare to compare, right? The next example what I'm going to show you is a different company, right? That is Prime Lab. They have used some other method to measure the progress towards the completion. So that's why it's a judgment to be made by the company's management. So this is the relationship between the risk of material misstatements and the accounting standards. So I have done a separate session to explain you the relationship between these two areas, because SL1 is a paper you need to look at from the perspective of a CFO. CFO should identify the possibilities of risk of material mistakes, right? So then he has to see that, okay, whether these risk of material misstatements are correctly addressed by applying the accounting standard in the correct way. Whenever there are judgments, estimates involved, what happens is there's a risk of material misstatements. Okay, the management might do mistakes. So one critical judgment is what? It's the judgment. How do we measure the progress towards the completion? Whether that judgment is exercised correctly, whether it has been applied properly, correctly in the, when preparing the financial statements. Right. So the progress is assessed based on survey of work performed. Now, this is also I have explained. When the outcome of the construction contract cannot be estimated reliably, you can't estimate the outcome. Let's say at the early stages of a construction contract, contract revenue is recognized only to the extent of contract costs incurred that are likely to be recoverable. Did we discuss? Yes. If the outcome is uncertain, revenue is equal to the recoverable cost. By considering the loss-making contract, I told you onerous contract. If you see that expected or overall outcome is a loss, a provision is immediately made in profit and loss statement for the difference between the expected cost of fulfilling the contract and the expected unearned portion of the transaction price when the forecast costs are greater than the forecasted revenue. So if you see that my total cost is going to be above the transaction price, above the total revenue, I have recognized 100% loss as a provision because that is an onerous contract. Again, I don't have that much of time to explain with numbers these things. That's why I said that, okay, please refer the videos, watch the videos back again and understand if you don't understand these things, because I simplified to the level which is possible at this moment. Okay. Then one other example I wanted to mention. Now, I think all of you are aware about this project undertaken by John Keel's Cinnamon Life, okay, near to Goldface. So that's actually a kind of a mixed development. What do you mean by that? So in that project you have many things. So it's a hotel on one side. Then you have restaurants, then a bar, in addition to that there are residential units where people can buy and stay there, and you have areas where you can rent it to the others, right? Now let's say in this particular case study, if you go through the balance sheet, you have an asset called investment property, and also investment properties work in progress. There are two line items. One is investment property, other one is investment properties which are work in progress. What does that mean? Because within the building complex, you can have units where you rent it to the others and earn a rental income. So that particular space you have recognized as what? Investment properties. Or else you might construct an entire building for that purpose. What is your purpose? Build it and thereafter rent into the others and earn a rental income. So then that particular property has to be classified as a what? Investment property. Earlier we discussed properties are classified as inventory if they are kept for sold. But if the properties are kept for the purpose of earning a rental income, we know that it's an investment. Then you have to apply LKS 40 for the investment properties, either cost model or the fair value model to be applied as the subsequent measurement models. Most of the companies are using fair value model because why? Fair value gains can be taken to the P&L and there are no depreciation, right? So the point what I wanted to make is, if you have investment property, out of that, if you are earning a rental income, let's say you enter into an agreement for a annual rent of particular amount. That particular amount is getting increased each year, right? Let's say you have the property, so you enter into a 10-year contract. So as per this 10-year period, there's an annual payment to be collected. So for you, it's kind of what? Lease contract now, right? You are the lessor on this particular lease. Now, if you are a lessor, you have to classify the leases into operating and finance leases. Hope you can remember, right? Lessee doesn't classify the leases into operating and finance. That's fine. For him, it's a lease. Apply SLFRS 16, you recognize the lease liability and the right of use the asset. That is for the lessee. But if you are a lessor need to classify the leases into operating and finance leases. Let's say if you classify this into an operating lease, irrespective of the irrespective of the pattern that you are getting the cash flow, you have to recognize the revenue on straight line basis, right? Because maybe over the 10-year period, the amount of the rental income that you are getting is getting increased year by year. But still, when you are taking the numbers to the P&L, you have to take that on straight line basis. I just wanted to mention that particular point as well. Rental income arising from the operating lease of investment properties is accounted on a straight line basis over the lease term. Yet again, if you can't remember the things that I explained, go back and refer SLFRS 16. One of the another important standard. Even in this question, even though there are no lot of information about the leases, if you look at the balance sheet, you have right of use the asset and you have lease obligations. That means there are leases are there in the particular question, right? So revise your knowledge about SLFRS 16 because it's a standard which is getting tested constantly, right? Okay. Then, if you look at the statement of financial position, right? If I go there to explain you, yeah. So this is your case study. I have highlighted the important aspects over here. This is what I was talking about, right? There are investment properties. And also, if you look at this, there's another line item called investment properties work in progress. Investment properties work in progress. What is that? That is, these are the properties which are being constructed to use as an investment property in the future, right? Because property is something which has to be constructed. It will take time. Investment properties means already constructed, generating a rental income, or else purpose is capital appreciation. To become an investment property, the property has to earn a rental income or it should kept for the capital appreciation. So those are the investment properties. Work in progress means to use as an investment property, it is under construction. So under construction, even it is an investment property, right? So the applicable standard is LKS 40. But the problem comes now. Let's say if you use the fair value measurement, because subsequent measurement of the investment properties either can be either at cost or at fair value. So let's assume you use the fair value model to measure the investment properties. But the problem comes with regard to these properties which are under construction. Sometimes you might not be able to reliably determine the fair value. So in that situation, actually standard allows you to recognize or to measure these investment properties which are in work in progress at cost until either the construction to be completed or else until you can reliably determine the fair value, whichever happens first. Up until it is to complete or up until where you can reliably measure the fair value, whichever comes first. Up until that, you can measure the investment properties which are in work in progress at cost, right? That provision is given in the standard, right? Then I told you earlier, so this is what I mentioned, there are right of use assets. And if you look at liabilities, you have lease liabilities. So that there are leases in this question, even though prominence is not given in the case study. Okay, right. That's about the annual report of access engineering. Now let me go to prime lands as well. With regard to prime lands, I have to go to page number 152 to explain you something. 152, right. Okay, so there also, I'm not going to, highlight the same things what I had discussed with regard to the other annual report, highlighting the important aspect. Look at this one. This is very important. This is what I have explained. Now, prime lands, they are selling properties. What are they? What are they selling? Apartments and lands. So they are selling apartments and they are selling lands. Look at this. Company enters into contracts with customers to sell properties that are either completed or under construction as well as lands. So three things. Again, read that para and see that you can understand before we move to the discussion. What it says, company enters into contract with customers to sell what? Completed properties as well as properties under construction. Company enter into an agreement during the construction process. Like most of the constructions, that is how it is, right? Because otherwise company doesn't have funds to construct by their own and sell it. So during the construction period, during the development period itself, so enter into the contract with the customer and selling lands. Now, what about the revenue recognition? Very important. With regard to the properties which are completed and kept for sale are inventory, no? Right? You can recognize the revenue with regard to the completed properties as well as the lands once the performance obligation is satisfied at a particular point in time. Because if the property is completed, or either if it is a land, when you sell, performance obligation is satisfied at a particular point in time. Point in time means at the point where the control is passed. Normally, control is passed at the time of passing of the legal title. Sale of completed apartments and lands are generally expected to be a single performance obligation, and company has determined that it will be satisfied at the point in time when the control is transferred. Simple. On the other hand, what is the other one? Under development. Property is under development. Look at this. For contrast, relating to the sale of apartment under development, you recognize the revenue over the period of time. But before do that, I have explained to you, you have to prove that one of these three conditions are satisfied. I told you, these are the three conditions. If one out of these three are satisfied, you can say that you are recognizing the revenue over the period of time. So with regard to prime lands, what they said was properties under construction, one of these three criteria might be the third one, most probably is satisfied, so that recognizing the revenue over the period of time. Clear? Yeah, this is depending on the terms of each contract, company will determine whether the control is transferred at a particular point in time or over time. I explained to you that. Then for contracts that meet the overtime recognition criteria, that means one of the three criteria, company's performance obligation is expected to be measured. This is what I mentioned. You remember what Access Engineering has done? How did they measure the progress towards the completion? What is the method that they have used? Output method, survey of work performed. But you see what Prime Land has done. They used a different method. This is what I said, that different companies are using different methods to measure the progress towards the completion. Right? That's why the management judgment is involved here. What it says, for contracts that meet the overtime recognition criteria, companies' performance is expected to be measured using an input method by reference to the cost incurred to the satisfaction of the performance obligation. Right? Okay. Clear. Okay, coming back to the presentation that we discussed. We discussed about the inventory, now about the financial instruments. So with regard to financial instruments, what is most relevant is with regard to the debtors, right? It was mentioned that so the company sold to the government is not making the payment, and the debtor balances have gone up significantly. And the allowed credit period is 45 days, but it is now exceeded. So which means a lot of impairment indicators in terms of financial assets exist. So that means what we have to apply the expected credit loss model to recognize the impairment allowances of these trade receivable balances, because trade receivable is a financial asset. right? You know, there are three stages. Stage one is performing. Stage two is, I would say this is stage one. This is stage two, stage three. So if it's a performing loan, you calculate the loss allowance based on the 12 months expected credit loss model, and you recognize the interest based on the gross carrying amount. What do you mean by gross carrying amount? Let's say, if I take an example, gross carrying value of an asset, let's say 100,000. I have already recognized an impairment allowance. Let's say 2,000. Then that would give me the net carrying value of 98,000. Let's assume in this particular financial asset, effective interest rate is 10%. Right? If it's a stage one, that means there are no issues. Customers are making the payment on due dates. You measure the expected credit loss only by taking the loss events in the next 12 months. And you calculate the interest income. That means you apply this effective interest rate 10% multiplied by the gross carrying value of the asset 100,000 to recognize the finance income. But if credit risk has gone up significantly, normally you believe that if the overdue payment, it's a reputable assumption, if the overdue payments are more than 30 days, right? If it goes beyond 30 days, you believe that credit risk has increased significantly. You are falling to stage two. When it's stage two, your loss allowance calculation should be based on the entire lifetime expected credit losses, not only for the 12 months, but still you calculate the interest income based on the gross carrying value. That is based on the gross value into the effective interest rate. But if you see that customer is credit impaired, he's bankrupt, he's not making the payment. Normally you believe that if the overdue payments are more than 90, you are in the stage three, right? He's not going to pay. A lot of indications are there. He's in severe financial difficulties. Then your loss allowances are to be based on the lifetime expected credit losses. And the other change is you calculate your finance income by multiplying the effective interest rate by net carrying value of the asset. I don't have time to explain the entire thing yet again. I have explained this in detail when it comes to theory sessions, as well as I have done a lot of questions in the theory, questions in the revision program as well by explaining this model. Once again, there was a past paper. I can't exactly remember the paper. There was a paper with regard to SLFRS 9. I'll tell you after the break what is that question is, right? So there's a question with regard to applying of this expected credit loss model, but we have done number of questions in theory classes. Please revise your knowledge. The other thing what I wanted to mention is, now even though there are these three models mentioned in the standard in terms of the expected credit loss model, if your trade receivable balances does not have significant financing component, what does that mean? Let's say if the credit period is within 12 months. Now, if you look at this particular case, it says that the credit period is 45 days, which means most of the receivable, it seems that almost all receivable are less than 12 months. So if the receivable balances are less than 12 months, we believe that there is no significant financing component is involved. There, you can apply the simplified model. What do you mean by simplified model? You don't need to look at whether a particular trade receivable or a financial asset is in stage 1, stage 2, or stage 3. You can straight away apply lifetime expected credit loss model for all the debtors for the entire portfolio and calculate the impairment allowance. Otherwise, if you apply this model, you have to see that, okay, what stage the particular financial asset is, what stage the receivable is at. But if you are applying the simplified model, when can you apply the simplified model? for the trade receivable where you don't have any significant financing component, which means trade receivable less than 12 months. So in this case, our trade receivable are 45 days, so that you can apply the simplified model to calculate the impairment allowances. You need to you need to check that whether company has correctly done or correctly applied this model and recognize the possible impairment allowances, because there are a lot of indications. If I go back in the case study to say that debtors are impaired, right? Because here it's mentioned trade receivable of the group and parent company has gone beyond the credit period. Then over here it's mentioned government and corporate sector are not making the payment on time, right? Yeah. Right. So, okay, one student helped me to say that that particular expected loss model question was tested according to him in July 2022. Thank you very much. Right. There's a question. Look at that question. Right. Okay, what it says is loss allowances should always be measured at an amount equal to, this is what I mentioned, lifetime expected trade losses for trade receivable and contract assets. Forget about the contract asset. What is important for you is trade receivables. If they do not have, significant financing component, which means within 12 months. So in this case, 45 days, so that you can apply the simplified model. Right. So then the impairment of assets, because hope you can remember when we were reading the case study and when we were looking at this first slide, giving all the information, we looked at certain machinery items are not utilized at its full capacity because there's a demand drop. So what is that? Impairment indicator. So when you have an indicator of impairment, you have to test that for the impairment where you are comparing the carrying value with the recoverable value. Recoverable value means higher of fair value less cost to sell and value in use, right? Value in use means present value of the future cash flows by using the asset and the ultimate disposal. Fair value less cost to sell means if you sell today, how much you can collect. So out of these two, you take the higher figure as the recoverable value, right? So then you compare the recoverable value with the carrying value. If the recoverable value is less than the carrying value, you have to book the impairment loss. I'm not going to go into detail, right, to explain these concepts because you should be aware about this. So I wanted to mention that there's an impairment indicator so that whatever the plant and machinery which is not utilized in full capacity is to be tested for the impairment and see that whether there are any impairment losses to be recognized in the financial statements. Then still, what are we discussing now? You should know where are we. We are still analyzing the first slide, which means the detailed slide about the three companies and the environment relating to this particular case study. So I'm referring to this particular slide. We are analyzing what it was there in this slide. So in this slide. Okay, most of the areas now being analyzed, right? Before moving to the other areas or the important areas of the case study, just analyze this and then move on to the other areas, right? Okay. So let me know with regard to LKS1, what is the applicability for that particular information given in the slides? For what this is applicable? Any guesses? Yeah, correct. So yes, going concern assumption, right? Because standard says that so the financial statements are to be prepared on going concern basis if you don't have any intention to liquidate or cease the operation, right? So management has to look at the information at least next 12 months from the reporting date when they conclude that going concern assumption is valid. So most of the cases, management conclude that going concern assumption is valid. So you prepare the financial statements by using the going concern basis. But if you have material uncertainties with regard to the going concern assumption, those uncertainties are to be disclosed. You can still prepare the financial statements by using the going concern basis. But if you have material uncertainties, those uncertainties are to be disclosed. Like you can't pay your debt on time. So that's a material uncertainty. You have cash flow issues. You have a tight cash flow situation, material uncertainty. You have to disclose those, right? Then, as I said, now in this particular case, one of the issue that the company might definitely have is their working capital is tied up in inventory, receivable, working capital is tied up. So they have cash flow difficulties. So that's a material uncertainty. What the management is going to do on that? Restructure their loans. So the material uncertainty is there, but you can explain that management is in the process of restructuring their debt. So through that, you believe that the entity can continue as a going concern entity. So then you prepare your financial statements by using the going concern basis. If going concern assumption is not valid, there you can't use the going concern basis. Then you have to use some other basis, maybe the breakup basis. There are significant changes in terms of the numbers that you present. You can't classify your assets liabilities into current and non-current. Everything would become current. Then your assets are to be measured at realizable. Okay, right. Okay. So basically what we discussed or what we did up to now is we discussed all the possible cases in terms of that particular introduction slide, right? We have done that. Then what I'm going to do next is, in addition to those areas, what are the other important paragraphs that would be, that is there in the case study and would be, can be raised in the examination. So it can be a situation where there's a risk of material mistake. Right. So what are the other areas in the case study? So we need to, pick these areas and further discuss and analyze how the accounting standards are going to be applicable. Okay, that is one. And the other thing that I could look at is most importantly, at the end, what are the, at the end, very important, what are the possible consolidation scenarios that can be tested in the examination? These are two things that we do. Now the introduction part and the analysis is over, but still the accounting standards are some more accounting standard application of some more accounting standards are yet to be discussed. That has to be done. And lastly, the consolidation relating areas that can be tested in the examination. Right. So what we can do is we can have a break. So let's have a 15 minutes break. Let's have a 15 minutes break. We rest and I'll start in 15 minutes and do the remaining discussion. So this particular PowerPoint presentation will be shared with you in due course, as well as I will announce at the end our game plan for the revision, because now I hope you have studied, completed the syllabus. So we have to spend time to discuss. Actually, I discussed most of the past paper questions in the past paper questions, accounting standards, even the consolidation model questions have been discussed. I believe that even the revision course is now about 80 hours of revision is including the revision course, right? A lot of past paper questions. So we need to discuss about the last time consolidation question. I purposely didn't do that because at least one question you do just near to the examination. So that has to be discussed. And also some other areas which I believe that might be important for the examination. So I'll tell you the revision plan as well in the remaining or coming 2 weeks at the end of the session. Okay, let's start. So this is actually what is mentioned in purple color. Font is the quotes which I have directly taken from the case study, right? So what it says is actually this Sunshine Group is successfully involved in the process of construction of buildings, highways, roads, apartments, and bridges that we discussed. So some of the ongoing projects were held up. Okay, some of the ongoing projects were held up due to the current economic downturn of the country, with the majority of the completed government projects remain unpaid by the government. the management of SAP has taken decision not to quote for new government projects tenders until the government settle the outstanding payment. These 2 points we discussed, right? So the projects which are not completed is in the work in progress. Whether now, if they are classified as inventory, whether NRV is less than the cost, and with regard to the money due from government is actually recognized as a customer debtor. So whether there's any impairment allowance to be recognized, to be looked at, that we already discussed. And also we discussed about how to recognize the revenue with regard to the construction activities of buildings, highways, roads, apartments, and bridges. All the revenue recognition principle steps have been discussed, major areas have been identified. So that means, so this is done, right? So my job is now simple because the things what I have already discussed, I don't need to go into detail. I just need to, remind you the things that we discussed, right? Then SRERL, that is the third company, what is given in the case study. Real estate company is a real estate and property development company with BOI approved multi-story condominium, a mixed development located in the heart of Kolpiti. You know what is mixed development, right? Mixed development means it has many things. It has apartments, it has residential units, it is a hotel, it has restaurants, a bar, like recreation activities. So it's a mixed development located in Kolpiti, and it comprises of 225 luxury units with floor area of 582 square feet. That includes saleable area of 410,000 square feet and value integration into every aspect, right? So basically, yet again, we discussed about with regard to this condominium revenue, how the revenue recognition standard is applicable. We discussed, and also I told you if these particular units now out of this, so out of these properties that the company has at the moment, some properties are used to rent into the others and earn a rental income out of those. So those are classified as investment properties. And also we looked at in the balance sheet, there are certain investment properties under construction. So if company uses the fair value model to measure the investment property, so the completed properties are measured at fair value, where you need to measure the fair value at the year end at each reporting date, and the fair value changes are to be taken to the profit and loss, and no depreciation is recorded. But the investment properties are being constructed if company can't reliably measure the fair value at the moment up until the reliable fair value can be determined, or else up until it is completed, you can measure the investment property at cost, right? Then I already explained to you how the inventory standard is applicable in terms of the properties. If the property is completed, or if it is a land which is kept to be sold, it is a inventory, and how it is applicable and what are things to be looked at, we also discussed. Then with regard to the condominium, how the performance obligations are satisfied, whether it is point in time or over time, all depends on what? You can't exactly say if it's a condominium, whether it is over time or point in time. That has to be decided based on the criteria, right? So we looked at, so first of all, standard says that look at 3 criteria. Okay, what are 3 criteria? If I discussed, if I go back, these are 3 criteria. So if one of these 3 criteria are satisfied, you can say that you recognize over the period of time. Performance obligation is satisfied over the period of time. If none of these 3 criteria are satisfied, you recognize based on the point in time. So agreement terms are really important. So once this standard is introduced, most of the property development companies who are developing these condominium properties and apartment construction companies, they have to change their contractual terms to match, or because most of them want to recognize the revenue over the period, right? Because otherwise, if you need to recognize the revenue at a particular point in time means what? You have to wait until the construction is over to recognize the revenue. After the construction, only the control passes, legal title passes, because normally control is passed at the time of passing the legal title. So because of that, people actually wanted to recognize the revenue over the period of time. But to ensure that one of these 3 criteria are met, most of the cases it's met, because why? if you look at the third criteria, you create specialized units, right? Because for a customer, if it's a condominium property, customer need the particular unit, right? You would say that if you have, 10-story building in 5th floor, I need this particular unit, which has a sea view or something. So specialized to the customer. And also, normally the contractual terms say that for the work that the company has done, contractor has done, there's an enforceable right to payment. So upon the satisfaction of the criteria, you can recognize the revenue over the period of time. But in the exam, it depends on the scenario, right? It depends on the scenario. So look at the scenario, what is given in the exam, and based on the technical guidance given in this slide, you have to answer to the question, right? Okay. Moving on. Sorry. So I was discussing about LKS 40 investment properties. If it's a land, building, or both a property, you classify as an investment property. Either if you have a rental income, your purpose should be to earn a rental income. That means rent it to the others and earn a rental income, or else your purpose has to be capital appreciation. So then only it would become an investment property. So, but there are significant balances under the investment property in this question. If you look at the balance sheet, as well as there are certain investment properties being getting constructed at the moment. So I'm not going to go into detail about, okay, what do you mean by fair value method, how to account for that. I believe that those things you all know, right? Then moving on, what are the other information that you have? Okay, so this is another important information in the case study, SRERL, that is the third company currently developing a prime land located in Jayawardhanapura Kotte, center of the capital city, to build and sell individual units. So these are individual units, not a condominium, individual units. This project held up due to scarcity of materials and the high prices caused by the restriction on imports. The project was held up because material prices are high, shortage of material, there were restriction on importing of these materials, so that it was held up. Currently, after the relaxation of import restrictions, prices have come down. Now the prices have been come down and the import restrictions also relaxed up to a certain extent. Hence, management decided to restart the project and market it among the locals as well as international buyers. Not only among the local buyers, you can market that among the international buyers as well. So when it comes to international buyers, you might get foreign currency payments. SRERL focus on niche customer base locally as well as internationally, and companies flexible enough to, this is important, customize each condominium or apartment, these are what I mentioned, to suit the specific requirements of the customer. So the apartment is, or the unit is specialized, right? Unit is specialized. So with regard to these specialized units, specialized sections, okay, with regard to the specialized units or the specialized segments, so that is customer specific requirements. So which means once seller has created the asset, seller doesn't have any alternative use. That is only for that particular customer. And also, if seller has an enforceable right to the payment for the work that he has completed, if 40% is completed, he is having an enforceable right to collect 40%. So in that case, what will happen is third condition of this slide. If I go back once again, third point of recognizing the revenue over the period is satisfied, so that you have recognized the revenue over the period of time. Is that clear? But there are other implications, because this project was started sometimes back, then it was held up. So whether the value in the work in progress, do we need to impair that amount? That also to be looked at. Okay, so if it is recorded under inventory, whether it is correctly valued. So is the net realizable value is lower than the cost recorded there, right? In addition to that, if you are selling to the foreign customers, you might get the proceeds in foreign currency. Then if the proceeds are received in foreign currency, right? If proceeds are received in foreign currency, what will happen? What is the applicable standard? LKS 21, effects of changes in the foreign exchange rates. So a little bit of detail about that standard. What that standard says is you have to record the foreign currency transactions at the rate of that particular transaction date. But what companies does is they use average figures, maybe the weekly average or monthly average as a practical approximation. You can do that if the currencies are not fluctuated significantly. That's fine, right? So the record the transaction at the date where the exchange rate prevails. Let's say if you put a, if you invoice to that foreign customer in foreign currency, right? You have to record, we have to convert the foreign currency amount into local currency by using the exchange rate at the rate of the transaction. But practically, companies are using the average rate, either weekly or monthly average. So then at the year end, at the period end, if those invoices are not settled, so this is actually from the customer side, debtor side. If the invoices are not settled, then that foreign currency data you need to convert to the local currency by using the year-end exchange rate. What is the reason? Because that receivable balance is a monetary asset, right? If you have foreign currency assets and the liabilities at the year-end, you need to look at that whether those foreign currency assets and the liabilities are either the monetary items or the non-monetary items. Receivable, payable, cash are all monetary items. So here in this question, what we have is mainly the receivable and payable. Receivable in terms of the apartments, if you sell it to a foreign party and invoice in foreign currency. On the other hand, you import raw materials from foreign countries, and if you have unsettled balances at the year end, you have payable balances. Okay, where you to make the settlement in foreign currency. So it is in foreign currency, so you have payable balances, you have receivable balances. So both are monetary items. If the item is a monetary item, that has to be converted by using what rate? Closing rate. What do you mean by monetary item? Fixed, you know the fixed or the determinable amount of unit of currency that you're going to get. Now, if it is receivable, you know exactly how many dollars that you're going to get, how many rupees that you're going to get, you know that. Then payable even, you know exactly how many number of units of currency that you have to pay to settle the obligation. Those are monetary items. Convert at the closing rate, that will result exchange gains and the losses, unrealized exchange gains and the losses. So those unrealized gains and the losses, where do you recognize? In the P&L relating to the monetary items. With regard to the non-monetary items, in this case, you don't have any non-monetary items. So because of that, I'm not going to spend that much of a time. For an example, if you have a land in a foreign country, so that's a non-monetary item. Okay, so examples of the non-monetary items, PP&E, intangible assets, what you call investment properties, then even inventory is a non-monetary item because you can't exactly say the fixed or determinable units of number of currency that you receive or pay in case of this asset or the liability. Those are non-monetary. So if they are non-monetary, different rules are applicable. Again, I'm not going to explain those in detail because not relevant to this particular case study. What you can have is monetary items, that is foreign currency receivable and the payables. Those are to be converted by using the closing rate. Exchange gains and the losses are to be recognized in the P&L. So with regard to monetary items, exchange gains and the losses are actually two parts. I have explained you this one. Unrealized exchange gains and the losses. How the unrealized exchange gains and the losses would arise? Because if you have monetary items, those are to be converted at the closing rate. That results unrealized exchange gains and the losses. Those are recognized in the P&L. Then with regard to the monetary items, let's say if the foreign currency transaction is settled during the financial year. Now, good example is you import certain materials for the construction activities. Right? Before the year end, you make the payment. Now, the date when you import these items and the date when you make the payment, exchange rate would be different. That would result in exchange gain, no loss. So that is what? Realized exchange difference. transaction is settled. It can be a gain or it can be a loss. Where do you recognize? Realized exchange gains and losses are also taken to the P&L. So that means when it comes to the monetary item, both realized and unrealized exchange gains and the losses are taken to the P&L, right? So that is what is applicable with regard to this particular scenario. This one. Right, moving on. What it says is SML. Another information, SML is collaborating with Research and Development Unit of RDA, Road Development Authority, to develop an innovative solution to appropriately modify the asphalt wearing hose and binder to enhance the durability of the road surfaces. Basically, they are developing certain chemicals or material to enhance the durability of the road surfaces, right? So, what is this? What is this? Very simple. What is the applicable standard? Case 38, intangible assets, right? Intangible asset, because why? Company wants to improve the quality of the company's product. They want to improve the durability of the road surfaces. So with the involvement of a third party, company is carrying out certain research. So the area is actually research and development. You know, research means what? Original, that means for the first time, and planned investigation to find out the new knowledge and the understanding, new scientific knowledge and understanding. So you want to have something better to improve the product quality. Then development means, now let's say, after you carry out this research work with the involvement of RDA, you find out, okay, this is the formula that we need to have this. Then the formula is not enough. You need to convert, make it to a commercially viable product or commercially viable material. Okay, commercially viable service. So in this case, commercially viable material or a product. So application of research finding is the what? Development, right? So, so to design a product or a material or a device, process or system, but before the start of the commercial production or use. That is also important. Basically, the development phase starts technically at the end of the research phase. Research means that you do the investigation of new or improved knowledge. So the results can be positive or results can be negative. We don't know the outcome. There's no certainty. So because of that, whatever the cost that you incur during the research phase, you need to expense to the P&L. Development means there's some sort of a certainty is there. You now know the formula. Only thing you need to put it to a commercially viable product or a material. So it would take some time, but there's some sort of a certainty. The cost what you incur during the development phase can be capitalized subject to the satisfaction of 6 criteria, right? There are a number of criteria to be satisfied to say that cost incurred in the development phase is capitalized. So I'm not going to go into detail again. So if the cost is relevant with the research phase, you expense as incurred, right? If it is the development phase, you need to look at whether the recognition criteria are fulfilled. Example one, now I told you there are 6 criteria. One criteria is the technical feasibility. Let's say you know the formula, but if you don't have the technical feasibility to develop that formula and to make it to a viable product, having the formula, having the knowledge is not useful because you can't convert that into a product. So that's why without the technical feasibility, one recognition criteria, even though you are in the development phase, if technical feasibility is not there, you can't capitalize the cost you expense to the P&L. So upon satisfaction of all 6 criteria, the cost incurred in the development phase, you can capitalize. So for your knowledge, I have listed out what these 6 criteria are, right? You can go through, and also if you want the explanations, you can watch the video. So you can go back and watch the videos. So these 6 criteria are listed. So you capitalize. And sometimes if the scenario given in the exam is uncertain, you can't say this is research, this is development, or else both are happening together. It's not clear. If it's not clear, being prudent, what you do is you charge the entire cost to the PNA. Right? Are we clear? That is what you have to know with regard to the research and development activities and the applicability of LKS 38 intangible asset to this scenario. Okay, right. Moving on. So I'm going fast because you have, this is very simple stuff, not that complicated, like the things that we have discussed, right? Going far, bit far. Because what is most important is look at after the counting standards, what can be tested under the group scenario. Right. What it's mentioned over here is during the financial year 21-22, new laws were introduced and minimum wages were introduced, but the company has not fulfilled, not complied with these new laws, right? That is the first point. Then there's a point where vice chairman of SCP, right, pointed out that group has not considered the allowances paid to the workers when calculating the monthly contribution to EPF and ETF. Then Finance Director Kamal mentioned that letters were obtained from the employees when joining the group, confirming that they were comfortable with the management decision of not considering the allowances in computing the EPF and ETF. Okay, so that is that legally correct? Right? Whether your EPF and the ETF figures, what is there in the financial statements are understated. Right? Then site managers from the outstation have recruited children as helpers, providing the economic difficulties and issues faced by their families, but they were not assigned any heavy work. By thinking about the families, you have done something wrong. By thinking about, okay, families in difficult situation, or to justify your decision, you mention like that and recruited child labor. But again, you say that you have not assigned them heavy work. So is that correct? Okay, so especially with regard to your, governance practices, is that correct? So, ESG reporting and all these reporting, sustainability reporting, integrated reporting, is this decision correct? Right. So the things what I want to highlight is, so the first para is breaking of law. So breaking of law would result penalties, fines. You have a present obligation. You have a legal obligation. Okay, to comply with the rules and the regulations, you have to comply with the minimum wage. One thing. The other thing is, once you are not comply, there would be additional penalties that you need to incur. Right? Those are also to be recognized. I think there's a requirement to make a provision for those. LKS 37, provisions, contingent liabilities, and the contingent asset standard is important. So what are 3 conditions? There should be a present obligation. In this case, actually, you have a legal obligation. Legal means either because of a law passed in the parliament or because of a court decision, right? So because of a contract that you have entered into, you have an obligation. Presently, there's an obligation as a result of a past event. Then outflow of economic benefits are probable, more likely than not, right? An amount can be estimated reliably. Rupee value can be estimated reliably. So upon satisfaction of these 3 criteria, you have to recognize the provision as a liability. Right? Are we clear? So it's not been recognized, it seems. There may be a possibility of recognizing that as a provision. That is the amount of minimum wages, the gap, because you are not paying the minimum wages means there's a gap. Not only that, fines and the penalties. On the other hand, some of the allowances on which that the employees are being paid, you have not computed EPF and ETF. What you have done was you have taken a letter from the employee. They are okay with that decision. But I don't think that court would accept that in case of an issue. So because of that, it seems that there are a couple of issues again. Your EPF, ETF contributions are understated. So EPF and ETF is coming under LKS 19 employee benefit standard. These are post-employment benefits. Those have not been recorded accurately. On the other hand, yet again, violation of law would result penalties, right? So where you have to make additional payments. So those might have been recognized as revenue layer law. Sorry, those might have been recognized as provisions layer, provisions layer law. So with regard to provisions, I'm not going to go into detail again. I told you you should have a present obligation as a result of a past event. So it can either be a legal obligation or it can either be a constructive obligation. In this case, you are violating a law. Because of that, it's a legal obligation. Again, if you breach a contract, legal obligation. Again, if you, if a court order is given, that is also a legal obligation. Okay, then there are another types of obligation called constructive obligation that would arise in the situations what we mentioned over here. Again, I'm not going to go into detail. If you can't remember, you can watch the videos related to LKS 37 to understand. With regard to the employee benefits, there are different types of employment benefits, right? What are different types of employment benefits? Remember, what are the employment benefits covered under LKS 19? Short-term employment benefits, right? Termination benefits, long-term employment benefits, and post-employment benefits. So there are 4 types of employment benefits are covered under LKS 19. So out of that, post-employment benefits mean after you retire only employee get this benefit, right? So there are 2 types of post-employment benefits. One is defined contribution plans and the other one is defined benefit plan. EPF, ETF are defined contribution plans. That is, entity's obligation is to contribute a particular amount into a fund. So by doing that, entity's obligation is over. Entity doesn't need to worry about whether the employees actually get the benefit at their retirement or not. So it's a defined contribution. Contribute that amount to a fund. That's it. So, but in this question, it has not properly recorded. So because of that, there's an understatement of the post-employment benefits. So that has to be recorded, right? Plus, there can be penalties where LKS 37 is applicable, right? So then, for your knowledge, defined benefit plans are what is defined there is the benefit. Let's say once you retire, a monthly pension, or else once you retire, lump sum paid as gratuity. So those are what benefit is defined. Okay, so the accounting for actually the defined benefit plans are complicated than the defined contribution plans. Okay, so because of that, mostly the exam questions are focused on defined benefit plans, not applicable in the case study. Right. Then in addition to the 4 types of employment benefits, this is your knowledge. In addition to the 4 types of employment benefits, there's another form of employee benefits which is not covered in LKS 19. What is it? Employee share-based payments. So for the employee share-based payments, even though that is an employee benefit, right? So the applicable standard is actually SLFRS to share-based payment standard, right? Right. Then there's another part of this case study to say that company is in the process of currently there's an HRIS in place, right? So, but they are in the process of migrating into a new HRIS system called HRMates. Now, this is the point. However, although Sunshine Group maintains a HRIS, it takes more than 45 days to update HR information of construction sites located in different places. And sometimes there are errors when feeding information manually by data entry staff. So where this would affect, so let's say there are construction work going on. While the construction work going on, there are people who are working on these sites. Their information is not properly entered into the system, or else there's a delay of entering these details. Delay in the sense, their salaries and all, right? So the employees are paid when they are working. Salaries, allowances, incentives. There's a delay of getting these things entered into the system, as well as there are errors. Where the implications would come? Inventory. Because why? Now these properties, what is getting constructed can be either be classified as inventory, or sometimes it can either be classified as investment properties. So in both cases, capturing the cost is important. Otherwise, there are errors in the inventory valuation. There are errors in the investment property valuation, because I said that if it's an investment property, if you are constructing a property to be future used as an investment property, during the construction, up until you can reliably determine the fair value of the investment property, you might measure the investment property at cost. So then if the salary details are wrong or not updated, the cost of the inventory, cost of the investment property would be wrong. Because if you look at the cost of the inventory, specifically mentioned that cost include, the first one is purchases, whatever the materials that you purchases, the materials that you purchase. And look at the second one, cost of conversion. Cost of conversion includes labor, energy, production overheads that you incur. So if the labor cost is not correctly captured, your inventory cost would be what? Wrong, right? In addition to that, any other cost to bring the inventory into the current condition and location. So the inventory valuation is getting affected if you don't capture the data correctly. Then I already told you, even though there are no prominence is given in terms of the leases, if you look at the balance sheet, statement of financial position, you have right of use the assets and the you have right of use the assets as well as lease liabilities. So because of that, pay attention to SLFRS 16, because it's always tested in the exam, might not be in the within the case study, but even in some, because it's a standard which was constantly tested, right? Which is a standard which is constantly tested in the exam. So before the exam, I will do a question in terms of the leases. I'll explain you the plan, as I mentioned earlier. I want to do one consolidation question, one question from leases. SLFRS 15 we discussed in detail today, right? So I'll tell you the plan. So, but I told you this, in case of the lease, lessor convey the right of use the underlying asset to the lessee in return for the lease rental payments. From the perspective of lessee, there's no classification into operating or finance lease, it's a lease. All leases are to be recognized in the lessee's statement of financial position, except for the two exemptions, low value items and the short-term leases. All other leases, lessee has to recognize in the statement of financial position, which means lessee has to recognize the lease liability and the right of use the asset at the inception of the lease. On the other hand, lessors need to classify, it's a must to classify the leases into the finance lease or the operating lease, depending on the criteria. You have to look at what is happening to the risk and rewards, whether the risk and rewards are transferred to the lessee or not. Depending on that, whether the lease is a finance lease or an operating lease, that has to be looked at by the lessors. Then I thought of, just explaining this, because if you look at the statement of financial position of the question, now this is the statement of financial position. I see that there's a deferred tax asset. Deferred tax asset. Normally, what you have is a deferred tax liability, but there are certain deductible temporary differences through that deferred tax assets have been recognized. Maybe certain, because this is the parent company's balance sheet, Sunshine Construction PLC, statement of financial position. Company column doesn't have any, deferred tax assets, but at group level, you have deferred tax assets. That means this has to be relevant with one of the other two companies, manufacturing company or the real estate company. You see, manufacturing company has made some losses during the year, and even the other company might have made losses in the past. So through that, it seems that maybe because of that, or maybe because of some other reason, deductible temporary difference, deferred tax asset has been created on the statement of financial position. Now we know the concept of deferred taxes. If it's a deferred tax liability through a taxable temporary difference, what we do is we recognize the liability in full, right? Liability in full. But if it is a deferred tax asset, before we recognize, we need to look at the recoverability. For an example, let's say if the deferred tax asset is recognized because of the tax losses that you are going to incur, right? You are recognizing the deferred tax asset because of the tax losses that you have incurred. Because how it has become a deferred tax asset? Because when you incur a tax loss today, that tax loss can be brought forward and set off against the future tax profits once available. So which means when you have profits in the future, you don't need to pay taxes because you can set off this tax loss. Okay, which means my future tax liability will be lower because of the tax loss that I have at the moment. So that's why we consider that as a deductible temporary difference, because in deferred taxes, you look at the future tax complete implications. If my future tax liability, if my future tax payments are lower, that is a deductible temporary difference. You recognize a deferred tax asset. But when you recognize the deferred tax asset, you need to be pretty sure that you can recover this deferred tax asset. For an example, let's say if you can't expect profits even in the future, now you have a tax loss at the moment, but for you to offset this tax loss and get the benefit, you need to have tax profits in the future. But if you expect that you can't earn tax profits in the foreseeable future, then there's no way to utilize this deferred tax asset which is created because of the unutilized tax loss. So because of that, obviously the information is not given in the question. So if it is tested, examiner will give you this information. You have to look at the recoverability of the deferred tax asset before you recognize it on the statement of financial position, right? Okay, right. Then one important thing, what I want to mention now in this particular reason, you have been given the information about how many companies? 3 companies. All 3 companies are, I think, related to each other, construction industry, I would say. So because of that, there are a lot of intercompany transactions which are carried out among these companies. So even though it's not directly mentioned in the case study, there can be, areas of related party disclosures to be made. So in the standard, what we do is, first thing, you need to identify all the related parties to the reporting entity. You have to understand from whose point of view the question is tested, whether it is from parent company or one of the subsidiaries. So whatever the entity for which the question is tested is the reporting entity. Then who are the related parties to this reporting entity? What are the entities would become related parties? Who are the individuals, key management personnel, their close family members would become related parties to this particular reporting entity. So the first thing is to identify the related parties, identify all the related parties. Then make the necessary disclosures about the transactions which have been carried out during the financial year, as well as what are the outstanding receivable and the payable balances at the year end. If you have made any impairment allowances with regard to the related parties, those have to be disclosed. What are the terms and the conditions on which the transactions are carried out, whether it is on arm's length or not, all these things are what? Disclosures. So here in this slide, what I did was actually, I have included all the possible types of related party relationships that the reporting entity can have, right? So all the possible types of related party relationships. Okay, so again, I'm not going to go into detail, right? So this slide is, so it explains in the slide. What you can do is go through all the types of related party relationships. And if you can't understand, what you can do is go back and again watch the relevant videos to understand who are the related parties to the reporting entity. So this slide explains what are the entities and what are the individuals who would become related parties to this reporting entity. What is in blue are the related parties. What is in red are not the related parties. Okay, right. This is just a refresh about the things that you need to be aware, right, when it comes to the examination. Right. So with that, actually, what we call the areas related to the accounting standards have been done, right? So almost all the areas have been discussed, and there are a few questions about whether one performance obligation or not. It depends on the contract, as I mentioned, right? So you have to analyze the contract and see that, okay, what you have actually promised. Normally, in case of a condominium, what seller is getting enter into to sell, the unit, the particular unit to the customer, right? So that is the performance obligation that he has with the customer. So the revenue recognition has to be according to that particular performance obligation that is promised in the contract. Normally, it's a one performance obligation, right? Normally, it's a one performance obligation. Because normally when you buy a condominium unit, you get the ownership of that particular block or the unit, as well as you can access to the land and the other resources. Right. So moving to the, I would say most important in the precinct, because we know for sure that the 50 marks question would have a consolidation question. But as I mentioned, if you look at the past papers in the recent examinations, in addition to the consolidation question, there were questions from the other areas, right? Most of the times it's related to the case study. Now, for example, last time the case study was relating to certain agricultural activities, right? So there was a question from LKS 41, right? So because of that, that's why actually we discussed the introduction about the case, the holistic picture, and the relevant accounting standards. But we know for sure that the consolidation question would be tested in question 3, that is in the unseen scenario. Now what we are going to look at is, by looking at the details, hints, what is given in the case study, what are the possible consolidation questions that can be tested. But I must emphasize that before starting, you should not focus on your attention only to the areas what I mentioned, right? Because sometimes in some sessions, unfortunately, examiner, without following the pre-seen, he tests something, abnormal in the unseen, especially with regard to the accounting stands. But consolidation, actually, most of the times he follows the, pre-seen, but in accounting stand, he might test something totally unrelated. Even in the consolidation, there were, couple of sessions, he tested something what is not relevant to the case study. But at the lecturers meetings and all that, we have pointed out these matters. So, but still, you never know. So that's why, yes, pay more attention to the areas that I have mentioned, but it doesn't mean that you should not look at the other areas. You have to have a good knowledge about the consolidation, all the areas of consolidation. Right? Don't take a risk, don't take a chance, because you know for sure that there will be a question. And the other thing is, before starting this, I just wanted to mention, not in your examination session. Actually, the first batch who face for the examination after some revisions in your syllabus is the last batch, June 2023 batch. Because before that, this paper consists some part of auditing as well. But since June 2023 examination onwards, auditing part has been removed. Right? So you have financial reporting, accounting standards, consolidation. Then the other areas are governance, risk, and ethics. There's nothing called auditing. Auditing standards are not going to be tested. Yes, you need to have the conceptual knowledge of auditing. You need to know the concepts like, internal controls, inherent risk, control risk. But the paper is holistic paper with the viewpoint of a CFO. What CFO has to do is not to carry out audits. What CFO has to do is, by looking at set of financial statements, he has to identify what are the risk of material misstatement. That knowledge is something what you need to develop. So this paper is actually is a kind of a good paper for you to practice to become a future CFO. But unfortunately, this risk of material misstatement, basically, there are business risk. Through that, there are risk of material misstatements in the financial statements. So thereafter, when the accounting standards have been correctly applied by applying, but when the accounting standards have been correctly applied by addressing these risk of material misstatements, so this connectivity was not there in the last time paper. So because of that, I believe that, and even as I mentioned at the meetings with the Sri Lanka, we have communicated these matters to the institute. So this time, I believe that they would test these areas in deep. So ensure that you know these areas, you practice questions and applied or looked at these areas really well. Okay, there's a question before moving to the consolidation. There's a question in relation to the impairment. Okay, let me answer to that question. With this annual report itself. 1 second. There's a point over here. See whether I can find it. Yeah, 1 second. Okay, anyway, so basically, the question is how do we do the impairment testing, right? So in this industry, when it comes to construction industry, you might not have many debtors, right? You might not have many debtors. You might have only few debtors. Few projects are going on with certain customers. One part is government. Now, with the government, it's a significant amount outstanding. What you do is you need to do the individual impairment testing first. Individual impairment testing means you have to look at that particular data, even the government, maybe some other, corporate customers which are having high receivable balances. What you can do is you can test them. You can first of all look at the individual impairment testing. There you might find out certain customers, including the government, is impaired. So you have to make a provision for that, right? You have to make an allowance for that. Then the other customers who were not subjected to this individual impairment, as well as the debtors, it was subjected to the individual impairment testing, and you conclude that there's no impairment. What you need to do is, for all of them, you can do the application of this Excel model, collective impairment. So in the question, I will show you later on, actually, I will find that and show you. It was mentioned in one of these annual reports how this process is carried out, right? Either in access engineering or prime lands, it was mentioned the process of carrying out the individual and the collective impairment testing. So answering to the question, you have to look at individually. Now, government is one customer. So whether there are any impairment indicators. And if so, what is the impairment loss to be recognized, impairment allowance to be recognized. And thereafter, each individual customer, significant customers, take it separately and test for the impairment and recognize the impairment allowance. Then the other customers who are not individually significant, as well as the customers who were subjected to the individual impairment testing and not recognized any impairment losses, you put it to the collective bucket and do the impairment testing. So this is how you practically do it. But in the exam, I don't think that examiner will go into that detail about these, practical applications. But just for your knowledge, remember this is how it is happening. Right. Okay. Now let's move to the most important part of consolidation, right? Consolidation. This is actually the summary of the same thing what I have explained earlier, just to give you before starting the consolidation relating area. If you look at the current situation, what has happened in the past is not relevant now with regard to consolidation. So the first company or the parent company is Sunshine Construction PLC, right? Sunshine Construction PLC. So if you look at the shareholding of the Sunshine Construction PLC, pay your attention 100%. So this is the current shareholding because Sunshine Construction PLC, SCP, it has been listed, it has become a listed entity since 2005, right? So once it has become a listed company, shareholding structure have been changed. And if you look at the current shareholding structure as it is given in the pre-scene, Punchi Banda holds 40%. He is the chairman of the company. Kosada, that is son of Punchi Banda, holds 16%, right? He is the vice chairman of the company, SCP. So, which means Punchi Banda and son together holds 56%. So, it's a family control, right? Then Kamal and Gamunua are two executive directors. Kamal is overlooking the finance, Gamunua is overlooking the operations. They have 2% each. Then the public holding is 40%. This is the shareholding structure of SCP at the moment, right? This is the shareholding structure of SCP. Then SCP has 80% holding in Sunshine Manufacturing Private Limited, SML. So which means SML is a 80% owned subsidiary of SCP. Is that clear? And SML has a non-controlling interest of 20% that is held by Somapal. There's an outside minority shareholder as well in SML. About the real estate company, Sunshine Real Estate and Residency, which is 100% owned by SCL, right? 100% owned by SCL, no minority shareholding involved there, right? This is the current structure of the group, okay? This is the current structure of the group. Okay, now we studied the case now. Can you tell by yourself? Can you assume, because it's about imagination, right? So what could be tested, right? What I thought might be different to what you are thinking, right? Maybe you come up with scenarios which I didn't think of, right? So now think by yourself and let me know. You can use the chat box. What are the possible scenarios according to you that can be tested in the question? Let me know. I'll give you, 1 minute for you to think and say that, okay, this possible scenario can be tested in the exam before I go to my scenarios. Yeah, give your answers. Okay, let's see what are the answers that you have given. Disposal. Disposal of SRERL, right? SML dispose due to loss making. Disposal of SREL, joint arrangement. SML fully or partly disposed. SREL approached by a foreign investor. Okay, right. Moving on. Right. So answer what we have given is correct, but there can be other scenarios. What I thought, right? Let me put into table what I thought, what can be tested in the question, depending on the information what is given in the case study. That is, now here they have mentioned at the very end of the case study, right? Pre-scene, finance director pointed out that due to existing import restrictions imposed by the government of Sri Lanka, supply chain of the group has been adversely affected, and poor quality raw materials were being purchased to meet the current requirement of the group at a higher cost after accounting for waste. Now, what has happened? There were import restrictions. So because of that, construction companies were finding it out difficult to get the relevant material. So they had to purchase low quality item from the local market at a higher price. Ultimately, the cost is high, quality is also deteriorated. So because of that, he suggested acquiring one or two local manufacturing establishments as a strategy to have good quality products and maintain company's vision, because company's vision is to focus on quality. Okay, top quality. So it's an indication, it's a hint, because if you look at the current situation in Sri Lanka, we can't be happy at the moment saying that, okay, now we don't have any issues. Now the fuel is there, there are no issues in terms of dollars. No, because now let's say if we start to repay the loans, what would happen the situation? So whether these import restrictions, dollar crisis and all that, would that come again? So what this company wants is to protect their supply chain, right? For the construction projects that they undertake, they need to ensure that continuous supplies are there for them to carry out the project. So rather than depending on the import sources, they might want to acquire companies which produce construction related materials. Now, at the moment, even they have certain companies, manufacturing company that manufacture concrete blocks that can be used for the construction project. Similarly, what about the other materials? Why don't we acquire companies who can or which can manufacture these materials? So that is the viewpoint of the finance director. So by going through that line, I believe that in the question, there can be an acquisition of a subsidiary or sometimes a group by the parent company. That is the first scenario, right? Acquisition of a subsidiary. We'll come to the disposal later on. There can be a disposal scenario. But look at this first, acquisition of a subsidiary or group by SCB. So are you all agree with what I have mentioned? Because none of you have mentioned about an acquisition. I don't know why. So in your answers, nobody has mentioned about an acquisition, but are you agree with me with this, proposal of the finance director? There can be a situation, to acquire a company or a group which manufactures the construction related material. Okay. In that case, what's going to happen? In that case, what's going to happen? What would be the group structure? So this is the current group structure as per the pre-scene. SCP has 80% of SML. SCP has 100% of SRE. Right? This is the current structure. So what is my first situation? Acquisition of a subsidiary or a group by SCP, which would become the group structure like this. Either it can be a subsidiary, only one subsidiary. Let's say SCP is acquiring a subsidiary which manufactures the construction related material. Or it can be a subsidiary which has another subsidiary. So then it would become what? Complex group. It's a vertical group, right? So at the moment, you are acquiring a subsidiary which is already having a subsidiary. So that's why I mentioned that it can be a acquisition of a subsidiary, one company, or acquisition of a group. Group means two companies. So then You need to decide what is the date of acquisition. You are preparing the consolidation from the point of view of SCP. The date of acquiring the control of this subsidiary as well as this sub-subsidiary, the date where SCP acquired this subsidiary, right? Because this sub-subsidiary might have been acquired by this subsidiary sometimes back in the past. But for the consolidation of SCP, both subsidiary and the sub-subsidiary is acquired on the date where SCP acquires or SCP gains the control over this subsidiary. On that date, you have to calculate the goodwill. From that date, you have to prepare the consolidated financial statements from the point of view of the SCP. It can be, as I mentioned, subsidiary only, or it can be subsidiary plus a sub-subsidiary. Okay, are we clear? So this is the first situation that can have in the question. Then you need to have an idea about how to prepare the consolidation in a vertical group or a complex group scenario. This is a vertical group. SCP, from the SCP's point of view, this is the subsidiary, this is the sub-subsidiary. Right. From the sub-subsidiary's point of view, this would become the parent and SCP would become the what? Ultimate parent. From the point of view of the sub-subsidiary, this subsidiary would become the what? Immediate parent. SCP would become the ultimate parent. Are we clear? Then this acquisition can also happen. Acquisition can also happen by SML. SML is the manufacturing company. So what you are going to acquire is the manufacturing company, another manufacturing company. So this acquisition can be done by SML. Right? So how to find the cash is a question, because SML is making loss at the moment, might be facing difficulties. But let's say some other means, let's say, you might take a bank loan, but it's difficult to borrow, that I know, of course. But by doing something, if they, acquire funding, SML can what? Acquire the subsidiary. That is this. Earlier, SCP is acquiring a subsidiary or a group, or else it can be an acquisition done by SML. Then yet again, if you look at this arm, what is there on the left-hand side is a what? Vertical group. Right? A complex group. You have to prepare the consolidated financial statements in a complex group. SML would become the subsidiary and the new company would become the sub-subsidiary. Are we clear? Are we clear? Right. Any questions here? Any questions? In the first case, now acquisition is done by who? SCP, no? To find cash, SCP is a listed company. SCP can do a what? Another share issue. Or they can do a rights issue. But with regard to SML, yes, there's a restriction, because at the moment they are making losses and, finding it difficult to, manage the cash flow because of the working capital problems and all that. But the examiner might say that, okay, new investor or somebody, maybe SML has borrowed money from somewhere, and through that they invested in a new company which manufacture construction materials. Right, now we discuss about this. This is clear. Now I am moving to the disposal scenario, what you have mentioned. So the group might think that, okay, group is having cash flow difficulties at this moment, right? Throughout in the case study, it's mentioned that economic conditions are unfavorable, tight economic conditions. Now, there's a company now, this real estate company, apartment building company, real estate company's negative net assets. I think you have noted down that, right? So if you look at the, over here, if you look at the case study, they have given the segmental information about SCP, SML, S-Rerun, right? So there, if you look at, this is the segmental reporting. So basically, they have done the segmentation based on the business segment: construction, manufacturing, and real estate. right? So if you look at this company, real estate company, total assets are 7,668. Total liabilities 11,312. Net assets are negative. Okay, might be they are facing difficulties in terms of the continuity of the business, right? So that's why we said that earlier there's a material uncertainty about the going concern assumption as well. Okay, so but good thing is they are making certain amount of money, even though there's an issue in terms of the balance sheet, making some money. That means profits are there. With regard to SML, it's not profitable. Made a loss, 38 million loss during the year. But net asset position is okay. And net asset position is okay. That's why I said that SML might acquire a new company because in the current year it made a loss. But if you look at the balance sheet, that is wrong. Right? And the other thing, before moving there, now I told you there are a lot of related party transaction that is evident, right? Because in segmental reporting, you take the revenue, profit, assets, liabilities of each segment, and thereafter you have to match those, tally those with the group numbers, consolidated numbers. Now to match with the group revenue, what you do is you have made an adjustment. So these adjustment are the inter-segment revenue, inter-segment sales. So which means there are related party transactions. Those have been eliminated when it comes to the consolidated column. Okay, right. Yeah, there's a good point made by one of the student. SML net assets are good because they have not booked the impairment losses yet. Correct. That can happen. Okay, so we discussed about a lot of matters where company might not have recorded the correct impairment relating to the inventories. Okay, so SML is a manufacturing company. So some of the inventories that they have might have been written off. So that has not yet been done. Because of that only there can be, at the moment a positive net assets. So that can be affected with the adjustments what is given in the unseen probably. Right? Okay. Moving on. Now disposal. So this is the group structure. Now forget about the equations, right? We discussed about a couple of equation scenarios that can be tested in the unseen. Now forget about those and think that this as a fresh scenario. This is the structure. SCP has 80% of SML. SCP has 100% of S rerun. So these are the equations that we discussed. If let's say S rerun or SRERL is disposed, what would be the group structure? Then what you remain is only SCP and SML. Okay, this would be the structure. Then you have to calculate the disposal profit. You have to make the disposal adjustment. How to calculate the disposal profit and all that to be looked at. Are we clear? Then it can also be a combination. What I believe is if a disposal is tested, you just have only two companies in the group, right? What can happen is now at the moment they are in a tight situation in terms of the cash as well. On the other hand, they need to acquire construction material manufacturing companies. What SCP can do is SCP can dispose S rerun. Then SCP collects money through that disposal. By using that money, what SCP can do? Either SCP acquire subsidiary or a group, or else SCP can transfer that funds to SML and SML can acquire the sub-subsidiary. So basically what I'm telling is this is a combination. Disposal of S rerun with an acquisition. Acquisition can be done by SCP as mentioned earlier, or else acquisition can be done by SML as mentioned earlier. Okay, so this is the other scenario. Other possible scenario with regard to consolidation. So if this scenario occurs, you should know how to account for a disposal of subsidiary, how to account for the loss of control, calculation of the disposal profit and all that. Plus, it would also create a complex group scenario because SCP has a subsidiary as well as sub-subsidiary in both these scenarios. Okay. Easiest would be sometimes SCP acquire only this subsidiary. If SCP acquire only this subsidiary, then there won't be a complex group. Then there's a disposal and acquisition. But if SCP acquire a group like this, or else if the acquisition is done by SML, then you have a complex group scenario. Are we okay with that? Do you understand the situations? Anyone want to say that, okay, this cannot be tested, or else have you got any new ideas after listening to me? If so, let me know, right? There can be. Have you got any new ideas now? No? Right. What else? Is this clear? So let me know, right? Is this clear? So this is very important. I'm spending a bit of time here because we have to understand the entire thing. So are we clear on this? Can we move forward? Yeah, okay, right. Understood. Okay, right. Okay, so what else? Then there's another hint. Okay, there's another hint. What is that? Sunshine Group did not declare dividends for the last 4 years, although the group had a good reputation for declaring dividends of 50 to 60% of profits attributable to the equity holders previously. Or previously, all the way since inception. From the beginning, group is paying dividends. 50 to 60% of the profit. Payout is 50 to 60%. The chairman, that is Punchi Bhatta, brought to the notice of the directors that until economy reaches stability and company becomes financially strong, profits will not be distributed as they need to be accumulated to meet the future development expansion needs. Now, the chairman has suggested to the board that past pattern of dividend payments are going to be changed. Until company is established, this recovery is done. To meet the future expansion development will retain without paying dividends. But remember, when you have public holding of 40%, not paying dividends for the last 4 years would not be a sound decision, because why? It's not only the family now. There are outside shareholders, they expect dividends. You might be able to convince the family and your friends, but might not be the public 40% of the shareholders who are having the public holding, right? So that's why even though the company, not making money up until now, because this is actually the financial management, you have to have a dividend policy. You should decide what is your dividend policy is, because dividend provide signaling effect to the market. Dividend, based on the dividend decision, investors take their decisions. So what can happen is actually it's mentioned here, a few investors of SCP, because if you look at the shareholder of SCP, this is the shareholder. This is the shareholding of SCP. Punchi Banda has 40%, Kosana 16%, Kamal Gamun 2%, public 40%. Now what has happened is, few investors of SCP are not happy with the management decision and are willing to dispose their shares. What can happen? So there can be a new investor who's not expecting that much of dividends, because there are certain investors who are not interested about the dividends. They look at long-term investment. They are more interested about the capital gains, develop the business and entitle for the capital gains. So investor of that nature, it can be a local investor, it can be a foreign investor, will acquire a significant shareholding of SCP, mainly through the public holding, and might be through the friends, might have Kamal and Gamnu might also want to sell their shareholdings. We don't know, right? So acquire significant shareholding of SEP. Then what will happen? But the point is, even if that investor acquires entire, you can't acquire the entire thing, entire of the public holding, still it's 40%. So might have been that investor can approach Kamal and Gamuno as well. Okay. In case, let's say, if Punchi Banda wants to bring the business into the next level, Punchi Banda and his son also might dilute their holding and give it to the new investor. Because it's mentioned that Punchi Banda wants to expand, develop the business. He has plans, but he can't do because why? At the moment, tight working capital. Compare doesn't have enough cash to make this investment. Some or the other, what can happen is there can be a new investor. That new investor would have a significant holding in SCP. So then this significant holding would result that investor to obtain the control over SCP. Sometimes, even though that investor has less than 50%, investor is given the control through a shareholder agreement. Okay, let's say if this investor, the new investor, if the new investor is having more than 50%, obviously new investor can get the control over SCP through the shareholding. But sometimes, even though the new investor, let's say new investor is getting only 35%, but the control can be given in way of what? Shareholder agreement, because there are other means, there are other ways where the control can be obtained. One is through a shareholder agreement. So the relevant activities are decided mainly by that investor. Investor can decide the relevant activities of the SCP. That right is given to the investor. Okay, we look at, there are a number of scenarios where the control is there without having the majority of the voting rights. Look at that list as well, right? Yeah, look at that list as well. Is that clear with you? So new company will acquire. So new company will acquire significant shareholding of SCP and obtain the control via shareholder agreement. So then you might be asked to prepare the consolidated financial statements from whose point of view? From that new investor's point of view. From that new investor's point of view, now SCP will become the subsidiary. And two sub-subsidiaries, SML and SRERA. Okay. Are we clear? Again, complex group. So you should know that what is the date of acquisition of each of these sub-subsidiaries and subsidiary, and how to prepare the consolidated financial statements in a vertical group. Right. Then the next scenario could be the same as this, but this new investor is not given the sole control. New investor and Punchi Banda jointly control SCP. Because Punchi Banda wants to bring the company to the next level. He is thinking about expansions. That's why he's not paying dividends. Now he's getting pressure from the shareholders. When he's getting pressure from the shareholders, he can't do anything unless otherwise he jointly share the control of SCP with someone who has money. So someone who has money is the new investor. So in this case, new investor has become the ultimate parent, but the next scenario can be new investor and Punchi Banda. This is Punchi Banda, right? So the Punchi Banda and the new investor, that is joint venture investor, jointly control SCP, and SCP would become what? Joint venture. SCP would become a joint venture of this new investor, maybe a local investor, foreign investor. Punchi Banda and the new investor unanimously take the decisions over the relevant activities of SCP. So the new investor and Punchi Banda jointly control SCP. If it's a joint venture, what is the accounting? Joint venture, equity accounting. Okay. So the new investor has to equity account the SCP. Okay, there are two types of joint arrangements. One is joint venture, other one is a joint operation. So as there's a separate entity established, and the parties have the rights over the net assets of SCP, this is a joint venture. So if it's a joint venture, accounting has to be done as per LKS 28, investment in associates and joint ventures, it is equity accounting, cost plus share of post-acquisition net assets. The remainder would be same. SML is 80% owned by SCP, S-Real 100% owned by SCP. Okay, are we clear? Any questions? So there's a question on calculating the disposal profit. So when you calculate the disposal profit, follow that particular format. First of all, you take the sales proceed. To that, you add the fair value of retained investment, if any, take the total. From that, you deduct net asset value plus goodwill minus non-controlling interest, if any. Right? If the net assets are negative, put the negative figure. Right? So it's a mathematical calculation. If the net assets are negative in the subsidiary that you dispose, put that negative figure. That's fine. Right. I hope you understood. Any other scenarios? I'll give you another couple of minutes. Any other scenario where you can think of? Any other scenario where you can think of? Right. Okay, so those are the things actually I can think of in terms of the consolidation, right? So it can be an acquisition, it can be a disposal, it can be a disposal with an acquisition, or it can be a new company coming in and acquire the control or the joint control over SCP, right? Right. So if now let's say if examiner wants to test a particular scenario, he will give all the relevant information, right? What is there in the case study is there with you. That means in the pre-scene, in addition to that, let's say if the subsidiaries balance sheets are required, examiner will give you the subsidiaries balance sheet. Don't worry about that. Whatever the situation he tests, because he's not going to test all these situations, whatever the situation that he's going to test, he will give you the relevant information to the computations. What is not available in the pre-scene, don't worry about it. Right. Then before concluding, I just wanted to actually mention this particular point as well. So this is, I highlighted earlier, connectivity of the risk of material misstatements with the accounting standards. I just wanted to mention this point. This is actually the audit report of Access Engineering, right? So they are, in the audit report, they have identified 4 key audit matters, right? In the audit report now, auditors are mentioning, okay, these are the high risks areas and what we have done to, address those risks. Look at the key audit matters that they have mentioned in their audit report. What is the first one? This is very important. No? What is that? Recognition of revenue. We discussed about that. No? I am reading only the highlighted part. Construction revenue is recognized over time, over the period, by reference to the group's progress towards the completing contracts. So they follow the overtime approach. Management judgment is required to estimate the total construction cost, variations, claims recognized as contract revenue, provision for liquidated damages that will affect the measure of progress, and revenue and profits margin recognized in the construction contracts. Okay. If these terminologies are used in the exam, don't panic, don't consume. I'll explain now. First part I understood, right? So with regard to the construction contracts, they believe that the performance obligations are satisfied over the period of time. So they use a method to measure the progress towards the completion. Whatever the method, survey of performance or the cost basis or whatever, they use that. But there are estimates judgment involved in terms of one thing. When you recognize the revenue, you should understand what is your revenue. Normally, revenue includes contract price. At the inception of the contract, both parties agree this is the value of the contract. Right? Both parties agree this is the value of the contract. But in addition to that, once the contract progresses, there can be other types of revenue that you to take into the transaction price. What these things are? Variations, claims. What is that? Variation. Let's say you are constructing an office complex. Initially, you decided, okay, this is the floor plan. This is how the rooms and all the other, arrangements should be. Then later on, with the construction or while the construction work is going on, you recruited a new director. Right? Now you need to have a room for him. And he wants to have a secretary. You have to have, some place for her as well. He or her as well. He or she as well. Now, what you do, it's a variation. You go and tell the party who is doing the construction, make this change. Will he do it for free? No. If you are the contractor, you will charge for that because it's an additional cost resources, but it was not agreed at the inception. That has to be taken to the revenue. But judgment has to be made when to take it, how much to take it. That's what is mentioned over here. Claims. What do you mean by claims? Now, let's say another example would be while you carry out the construction activity, you have, once you are doing the construction activity, you found that when you are digging the ground, there's a rock. So you have to, break this rock or, do something. Otherwise, you can't carry out that construction work. So for that, you have to bring additional machinery. So you have to take additional people to do that activity. That was not initially agreed in the contract, but it has to be done now. You do that and claim that money from the customer. Otherwise, it's a cost to the contractor. Claim, right? You are claiming. So these claims also would be added to the revenue. So the management judgment is involved, how to take it, when to take it, how much to be taken. Right? Those are part of contract revenue, in addition to the initially agreed price. Then provision for liquidated damages. What is that? Normally, when you agree on a construction activity, you agree a time period. Let's say you agreed within 2 years, you are going to complete. If not, now the client has, planned the business work to start in 2 years' time. So because of that, in certain contracts, you include liquidated damages, which means if you can't complete in 2 years' time, if you can't complete in 2 years' time, you have to pay the damages to the client. For each day this much, or each week this much. It is mentioned in the contract. So when you see that you have to make these payments, now let's say construction work is going on. After 1 year, you realize that I'm not going to meet this target. I have to pay this much of liquidated damages. For that, you need to make a what? Provision. Credit provision account, debit cost. It's an additional cost, which you have not forecasted at the inception. So the outcome would be changed because your estimated cost structure would be changed. Right? That means overall outcome of the contract is going to be changed. So those has to be recognized. Again, judgment is required, how much of provision to be made. Now, under the current context, a lot of interruptions have been happened because of the COVID, because of the import restrictions. Now, seems that a lot of construction companies were struggling to complete the projects. Not only that, they had this liquidated damages clauses in terms of the liquidated damages in their contracts. So that's why a lot of construction companies are struggling, closed down. So how to take these things into account, because those would have an impact on revenue, cost, and the profit margin of the construction contract. So that's why auditors have identified this as a key audit matter, right? Then look at the second one. That is, we discussed, so the company has investment properties. If you look at the balance sheet of the pre-scene event, you have huge amount of investment properties, and certain investment properties are in work in progress stage. What is the what is the risk. So if you use the fair value model, whether the investment property is correctly fair valued, as well as properties under construction, whether you can determine the fair value reliably or not. If not, you keep that at cost. Okay, so what is mentioned? Management assessment of fair value of the investment property is based on the valuation performed by a qualified independent valuer in accordance with the recognized industry standard. It is done by a qualified valuer as per the industry standard. Further, the prevailing uncertain and volatile macroeconomic environment introduced significant estimation uncertainty in relation to the measurement of the market value of the investment properties. So the property market has become inactive, right? There are not that much of transactions at the moment. So the economic conditions are unfavorable, volatile. Can we derive the correct fair value? This is another key audit risk that it has been identified in the annual report of Access Engineering PLC. Next one, I'm not going to discuss. That is actually they have subsidiaries, impairment assessment of goodwill and investment in subsidiaries. This is also important, right? Because now, because in this case study, you have the parent company, the subsidiaries are formed internally by the parent company, right? If you look at our structure, current structure, this is the current structure. In this structure, SML and SREAL are both are formed by SEP. So those are not acquired, so that you don't have any goodwill figure. But the investment made in these subsidiaries, in the individual accounts of SEP, you have in the individual financials of SEP, you have a figure called investment in subsidiaries. If subsidiaries are not doing well, especially SREAL, we looked at net assets are negative. On the other hand, SML is making losses. So this investment in subsidiary figure in the individual accounts of SEP is that impaired. So another key audit matter, right? Okay, that is what is mentioned over there. Impairment assessment of goodwill. You don't have goodwill in this case, but impairment assessment of investment in subsidiaries in the individual separate financial statements of the parent. Right? And this one. What is that? In the construction industry, we identified government is not making payment, corporate customers are not making payments. A lot of high value individual debtors. We discussed that if the objective evidence are available, in this case evidences are available, you have to do the impairment testing. First of all, individually, if it is impaired, book the impairment loss. Thereafter, if it is not impaired, put that to the collective impairment. Okay, along with the customers who are not subjected to the individual impairment. First of all, individual impairment testing. If it is impaired, book the impairment loss. If not, put it to the collective and do it with the other customers. And also we looked at most of the debtors in our scenario, what is going in the pre-scene, where the credit period is 45 days, which means there's no significant financing components involved, so that you can apply the simplified model in the expected loss model. Right. So there are inherent risks relating to the customer's credit risk profile, which varies due to the size of each customer and the industry that each customer operates in. Because with the economic downturn, certain industries are heavily affected. Certain industries are not. If you are a corporate customer for whom that you carry out the construction work is in an affected sector, like tourism was, now it's picking up. Sometimes back really affected. Okay, so depending on the industry that the customer in, as well as the size of that particular customer. The risk is whether trade receivables are recoverable and determining appropriate provision for potential impaired trade receivable require management judgment. Impairment allowances represents management's best estimate of the losses expected within the receivables as at the financial position date. Management has assessed the receivable balances individually based on the age of the debts to identify any objective evidence of impairment. These are I mentioned, right? So these are I mentioned. So normally in the construction industry, you don't have that much of customers. It's not like a manufacturing and sale of, FMCG products, right? So you have projects. So you know each and every customer. So you know the age analysis of each and every customer. So you don't normally do the individual impairment testing. But as an additional step, after doing it, if you have not booked an impairment loss, do the collective impairment as well. Then it's prudent. Okay. So as I mentioned, it's mentioned in somewhere in the annual report as well. I'm pretty sure, but can't locate the place. Might have been, I'll let you know later. Maybe in a future session, but that is how it goes, right? Yeah, so this is what actually I wanted to explain to you in terms of information available in the present, and we discussed about the accounting standards, we discussed about the consolidation aspects as well, right? So I will share the document with you after the session, don't worry about that. So what we to do, yeah, this session is over, hope you understood. But let me tell you what would be the future plan. This is done, right? This is done. Right, okay, students. So let's make a conclusion to the session. Bye.
Infinity Space. වෘත්තීය ගිණුම් කරන අධ්‍යාපනය සඳහා වෘත්තීමය සන්නාමය